The automakers, Guy was bringing that story to us about delaying plans around EV battery components. The house builders in the UK and Inditex as well, it's a gauge on the consumer.
Yeah, absolutely. So we're focusing on Inditex, that European consumer in focus. As you point out, basic resource stocks worth watching, especially after the negativity of yesterday. It wasn't just energy stocks under pressure, but basic resources as well. So we could see some bounce there. We'll continue to monitor the many strands of political risk that seem to be playing out for markets, in particular in connection with emerging markets this week. All of that very much front and centre. So European equity markets then opening up this morning. And Tom, I see the FTSE 100 out the gates up about 0.1%, the DAX up 0.2%. So we are seeing a bit of a rebound, slightly more modest than anticipated perhaps. The DAX now up by 0.4% as we wait for the ECB and the jobs report later on this week.
And look at the Inditex story as well, lifting the IBEX over in Spain, up 0.9% on the index, up 4%, close to 5% on the back of those earnings that broadly were in line, but it was the sales number, I think, possibly that analysts are hanging their hat on in terms of the upgrade, or at least the number that came through, 12%. The margin story looks a little bit better for Inditex, and of course you tie that into expectations around rate cuts. Maybe the outlook for some of these consumer-related companies is looking a little brighter, Guy.
Tom, this is the story, though, isn't it? And let me just kind of tie this back into the conversations I've been having over the last few days with airline executives. I talked to Ed Bastian about this from Delta. You talked to what is happening over at United with Scott Kirby. You talked to Ben Smith over at Air France KLM. They're all talking about a consumer that still has the potential to go out there and spend. They're still talking about this really buoyant consumer. Now, maybe that is at the top end, but that certainly seems to still be the driving force when it comes to the consumer picture, both in Europe and over in the United States. And it does seem to continue to confound expectations just how buoyant the consumer is. And another reflection of that in these Inditex numbers, Zara continues to power ahead. And the top line, yeah, you're absolutely right, Tom, is where the surprise really comes from once again.
So we continue to watch the Inditex numbers. That stock up by 4.7% this morning. Just reading some of the reaction from Bloomberg Intelligence this morning, talking about the strategy talking about the consumer there, towards more automation to improve customer service with a parallel track to sharpen the fashion stance. So we'll continue to watch what Inditex is doing this morning. I think we've got some movement in some of the cars as well this morning, Tom.
So we're expecting some of the sales data, sales numbers coming through from Volvo Cars. We have that. The stock is up 1.4% so far in the session. In terms of the data that's coming through, the numbers coming through at a time, of course, when we're weighing up the relative slowdown in growth for electric vehicle demand in Europe. The growth is still there, it's just it's slowing. Volvo Cars saying that May car sales were up 13%, so an increase of 13% for the month of May in terms of car sales for Volvo. Fully electric car sales up close to 60%, suggesting maybe that there's still a little bit of resilience. How much of that is done to price cutting coming down from Volvo? Of course, they've had support as well from their overall owner, Geely, over in China as well, in terms of support for that company. Again, sales up for the month of May, fully electric cars up close to 60%.
Yeah, just looking at the sectors then, we've got retail stocks lifted by Inditex. That's the best performing sector, up by 1.8%. Only one just in negative territory, that's basic resources. And so that continues some of its negativity of yesterday, which in itself is interesting. So retail, technology, consumer products and services on the rise this morning. Let's think about the wider stories that we're dealing with in markets right now. We need to think about political risk. And I'm pleased to say we're joined by Sophie Lund-Yates, who is a lead equity analyst at Hargreaves Lansdown and joins us now. Sophie, very nice to have you with us this morning. Political risk is something that we are very focused on in 2024. We've had had a few examples just this week of where markets have been wrong-footed, perhaps, in terms of their expectations and then the outcomes of various political events. A lot of those are focused in emerging markets right now. Some risks for some and some opportunities for others, no doubt. What have we learned so far about political risk and how it's going to play out in 2024?
Yes, absolutely. This is certainly a theme that we're not going to get away from anytime soon, not just this year, but I believe it's more entrenched more broadly, and that will be the case for the long term. Now, particularly with emerging markets, what we've learned really is this is a textbook example of the increased risk that comes with EM categories. Now, obviously, we continue to believe that there are still some excellent opportunities out there, particularly when you look to places like India. However, those political landscapes are particularly volatile, and also because we know that they are even more closely linked to, say, social outcomes as well, which can have, as you know, very, very broad ramifications across markets. It is essentially this textbook reminder that the EM regions are basically facing these risks really head on, and they do have far more reaching ramifications than they do, say, for Europe and the US, dare I say it, when it comes to market reaction.
So the politics in emerging markets front and centre right now, Sophie. We'll have plenty of politics in the UK soon to talk about, and in the United States as well. Thinking about the UK story, I mean, the FTSE 100 obviously a little disconnected from the UK domestic narrative. The other indexes may be more a reflection of that. But we've had real strength in the FTSE 100 in the sense of taking us to new all-time highs. But compared to other markets, maybe not as well performing. So, for your thoughts then on UK assets and where you want to get exposure at this point?
Yeah, sure. How nice it is to be on here, though, and talking about a FTSE rally. That certainly hasn't been happening too many times recently. Now, really, what I would say is when you do look at the FTSE, yes, okay, it's had a pretty good run over the last couple of years in particular, particularly year to date. However, what I would say is, as you've just alluded to, of course, we are lagging other regions. Now, a large reason for that simply is a lack of exposure to the super high octane stuff. Now, I am, of course, referring to tech. However, what I would say is within that, I do think that it's masking some potential opportunity in the UK. It's not just that we don't have as much exposure to tech. We have exposure to very cyclical, very beaten up sectors, like some of the big financial giants, like some materials. And I do actually think that there remains quite a lot of opportunity in the UK for those that are prepared to potentially take a little bit more risk. But I do think, for example, the house builders that you were just talking about there, we have some really differentiated names in there with wrought iron balance sheets. It's the same with some of the big banks as well that I think really might be worth some attention at the moment.
Sophie, how much of that is premised, though, on the idea that we are going to see rate cuts? It's really interesting. The story of the last couple of days has been maybe that actually European inflation, Eurozone inflation, maybe is a little stickier than anticipated. Yes, we may get a rate cut out of the ECB. Maybe we'll get a rate cut soon out of the Bank of England as well. But what comes next after that seems to be very much in doubt. And I'm wondering how much this European rally is premised on the idea that European central banks are going to be cutting rates. And I'm wondering what that rally therefore looks like if they don't in the same way as the market currently is anticipating.
Absolutely. I mean, we've been saying this for some time, and I believe that there is a disconnect still between not necessarily the timing of the first cut, but the extent of cuts, I think, more broadly for Europe and the UK. I don't think necessarily are matching up with market expectations. Do I think that could cause a dent or a pause in rallies? Absolutely. But actually, I think so much of it is reliant on what you were talking about earlier, and that is the strength of the consumer story. That remains really quite a really strong underpin for a lot of these businesses, and also the margin story. So we know that margins were going to be difficult to inflate this year, but actually overall the picture there isn't as bad as expected, and that is what really analysts and the market have a really keen eye on as well. But what I would say, just to slightly contradict myself, obviously as we head into these summer months and the corporate news starts to slow down, the emphasis on the macro does start to get highlighted because there's nothing else really guiding markets. Yeah. So actually, for now, I do think that interest rate story will probably carry even slightly more weight than usual.
But okay, let's pick up on the consumer and talk more about that. Why do we keep underestimating the consumer, even the European consumer? There seems to be this expectation that the consumer is going to roll over. And we continue to see strength, particularly in the States, I appreciate, but to a certain extent here in Europe. We're about to see the football kick off as well. You've got the Olympics coming up. It's a big summer in terms of consumer spending. How do you think that gets reflected in valuations? How does it get reflected in anticipation, actually, of further spending?
Yeah, absolutely. So you're absolutely right. I think really what people are concerned about, and by people I mean the market, there seems to be, as you say, this constant drip feeding of fear that, okay, now is the end of the road, now we have run out. And I think that has stopped valuations from really peaking necessarily to where they deserve to be in the case of some of the high caliber travel stocks, and particularly you were talking about earlier. But I do think that in terms of the mismatch, in terms of why that's happening, is as much as, yes, we are seeing consumer resilience, it is not evenly spread. So this isn't a broad-based kind of rally in terms of consumer spending. They are still being discerning. You know, certain travel airline in particular are doing much better than others. You know, Zara's doing brilliantly, but other mid-chain fashion isn't. So it's really, we are really seeing a very dramatic version of best in class being rewarded here as well. So it's not a case of this is a rising tide that lifts all ships. I think that there is a lot more specific stock stories going on here, and they are obviously harder to discern, and you're not going to see those broad-based moves.
Yeah, it's a more complex picture, isn't it, when it comes to the consumer, whether in the US or Europe here in the UK. So if you talk about opportunities in the UK, whether it's the bank space or indeed the real estate, the house builders, as you touched on. In terms of the timing then, with the political uncertainty, or is there uncertainty here in the UK? That's maybe debatable. And then the BOE. How are you thinking about time? Do you need to wait till you have clarity on the politics and on the Bank of England before you want to get that exposure, or do you want to be positioning now?
I certainly think that, well, firstly, to kind of address that first comment, yes, there is a bit of uncertainty here in the UK, but I don't think the market is overly concerned, really, because we haven't got that huge polarization that maybe some other regions face. But at the same time, in terms of gaining exposure, really, what we would say is you want to be looking at the strong caliber stocks, looking at all of the kind of fundamentals that you would be considering normally, rather than trying to necessarily time this around political shocks, because if it's not this shock, it'll be something else that we can't predict. So actually we'd say, you know, kind of gaining exposure as and when those opportunities present themselves, rather than trying to gauge it on which way the election is going to turn out.
Sophie, thanks so much. Thanks for joining us. Nice to see you. Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Let's get into a quick check on some of the stocks that are on the move this morning. Inditex, we'll start there, shall we? The owner of Zara. And that stock is up by 4.7% this morning. We've talked about how it was some of the top line that did impress. And I'm just reading some comments from a Jefferies analyst saying the trading break update was an impressive start. And as a result, he's expecting a modest upgrade to consensus. So we'll certainly look for that. Does seem expectations are on the rise, as you can see reflected there. The company does have, and this is interesting, on technology and on consumers, the company has a plan to spend $1.8 billion on improving stores and technology. So we'll see how that plays out. Increasing logistics capabilities, part of the goal there. Guy, you're watching some of the auto sector.
The entire auto sector is higher. So if you go to the sector story, every single stock in this sector is travelling higher this morning. Volvo is the story that stands out. It's up by 1.7%. But it's interesting, some of the German car companies are certainly lagging this morning. You've also got this idea that maybe you're going to be seeing Mercedes and others, Stellantis, maybe kind of reining back in once again their expectations, their ambition when it comes to EV. And I think that's a huge story that continues to be sort of negotiated, and I still think there's a lack of understanding about ultimately what this is all going to mean. The whole idea was we were going to use ICE engines to drive the profitability story into the EV story, and that's being undermined at the moment. It continues to be undermined, and I still don't think that is fully understood yet in terms of the implications of it, and what the Chinese are going to do in particular in terms of their interest here in Europe as well is probably not understood fully either. Tom?
Well, autos, yeah. I mean, autos. You know, it's not just about the batteries. It's also about the chips that get packed into these vehicles. And on that question, we've had some developments. It's the Intel story, of course, over in Ireland. The deal there with Apollo, $11 billion US dollars. And then some news coming through from NXP. It's a Eindhoven, Netherlands-based company doing a deal, a partnership with a TSMC-linked company to expand their footprint and investment over $7 billion in Singapore. Singapore really doubling down, as you're seeing as well in countries like South Korea and Japan, in that part of the world, in terms of building out the infrastructure, at least these foundries as well, and factories to build out and continue to crunch out these chips. So that's interesting as well. There's a read across to European chip makers. ASML, of course, essential and the only company that's able to provide, of course, the most high-end lithography machines to companies like TSMC. So ASM are getting a lift on the back of this, up 1.2%. ASM International, also based in the Netherlands, up 0.6%. ST Micro of France gaining 1% on that story. Also worth mentioning briefly, Bayer, that stock up a little shy of 2%. It was at 2% on the lines. The Bayer saying that actually, in terms of the verdict coming through from the US and the potential costs linked to the Roundup weed killer, that of course there's faced allegations of causing cancer, that the total number has been moved from 2.25 billion to 400 million. So a significant reduction by a US judge, and Bayer is gaining on the back of that news, close to 2% currently.
Okay, coming up on the programme, we'll dive into some of the earnings stories, in particular to the Zara owner Inditex, as it reports better than expected sales for the season. We'll take a look. That's coming up shortly. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
As we see the supply chain improving, we keep ramping up. So the more they produce, the more we need, and we are very fortunate to have in front of us a very important backlog of orders to deliver. But that comes with higher rates if we want to be at the pace expected by customers, and therefore I think it will at least take 2 to 3 years to see a certain normalization.
Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan, it's not our regulator's plan. If we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror.
The CEOs of Airbus and Boeing joining us yesterday at the Berlin Aviation Summit, which is taking place just over the road here, talking to my good friend and colleague, Benedict Camel. That was the CEO of Airbus. Dave Calhoun, the CEO of Boeing, talking to me. Guys, what they're talking about is the fact that they've got a supply chain issue right now. There is lots of demand within the aviation sector. Boeing's got its own issues that it needs to deal with right now. Dave talking about the fact they need to be transparent. I asked him how long it's going to take to get this business back on track. He says however long it takes. I just wonder whether the market, whether their customers are really going to give them that kind of length of time. There is an insatiable demand out there at the moment for new aircraft. Everybody wants new planes. Demand remains very, very strong. That's what all the airlines were telling me over the last few days. That's my real takeaway over the last few sessions. This is an aviation sector that is still capacity constrained. It is not demand constrained. And that feels like it's inflation to me as well, once again, in this sector. Anna?
Right. Well, that's really interesting, the extent to which, yes, that supply and demand dynamic is inflationary. We've seen airfares play a role in some of the inflation numbers that we've been talking about over the last year or so. Something else that some people talk about as being inflationary is a sort of global decoupling, a fragmentation of the global order to some degree, and putting up barriers between China and the United States. Yep. Some people point to that and the reshoring and all of that being reflationary. And I know that that is something that is on the minds of some of these aviation businesses.
Well, talking to Dave Calhoun about this yesterday, I have to say I was quite surprised how kind of strong and passionate he was on this issue. Clearly, Boeing is America's largest exporter. He has a huge vested interest in free trade, in globalization, and that's going into reverse right now. And he talks about the fear that he has around what is happening around the world. He's worried about what happens after the US election coming up. He's worried that we're going to see further fragmentation. That's bad for his business, but he just says the implications of it are likely to go even further from a societal point of view, but obviously we've also talked about the inflation point of view as well. He's really worried about it, and I have to say, more and more people that I've been talking to over the last few days around the world really focusing increasingly on this US election, which they're finding really hard to call and really hard to understand.
Yeah, where, of course, Trump, if he gets into office, has promised further tariffs on China. So implications potentially for Boeing from that. Talking of inflation then, services PMI coming out from Spain. The reason I mention inflation is because we know there is scrutiny by the ECB and other officials on the wage story in Europe and the relative stickiness of services. And this is a pretty strong number coming through from Spain in terms of the PMI, services PMI, for the month of May, 56.9. Close to 57 then, well above that 50 level that divides expansion from contraction. So 56.9 in terms of services out of Spain, composite of 56.6. Both of those numbers coming in above the surveys out of Spain. And one wonders if that is a factor that feeds into the conversations from the ECB when they meet tomorrow. Let's get back to the consumer story, though, because Inditex shares are gaining today after the Zara owner reported a better than expected start to the season and first quarter earnings that met expectations. Still on the Spain story, of course. Let's bring in Bloomberg opinion columnist Andrea Felsted for the take on this. Lots of talk about sales potentially slowing. That didn't happen for Inditex. What do you read into these numbers? Do you think this is sustainable?
Yes, they are very strong numbers, considering the weather hasn't been that great this spring. Zara in particular, still doing very well.
Yeah, all the talk was of all the rain, all the bad weather, the cold was going to make people not go out and buy summer wardrobe, but apparently they are doing. So that's interesting, and we take that for the sector. Andrea, let me also ask you about what's going on with Shein, potentially listing in the UK, and there's been much talked about. Also, we've seen politicians sort of angling to try and make contact with the leadership of this business. What's the latest on that?
Still talk it's going to float in London. We are waiting for any kind of announcement. Nothing yet. I don't think this is a threat to Inditex. I think Inditex has been lifting its prices upwards. It says it's not a deliberate policy, but it's stretching upwards with quite pricey items. That's a sweet spot. Luxury brands really increasing their prices. The mid-market really shrunk during the pandemic. Inditex is filling that gap. That's quite a different market to Shein.
Okay, potentially the biggest IPO for London, if that comes to pass, $50 billion US dollars or so from Shein. Of course, the company is based in Singapore but founded by Chinese entrepreneurs. Bloomberg opinion columnist Andrea Felsted, thank you very much indeed. Let's get to more of the top stories on the Bloomberg terminal this Wednesday. And switching focus, and pretty dramatically, where Hamas has followed Israel in balking at President Joe Biden's efforts to end the war in Gaza. Both sides say their conflicting conditions for a permanent ceasefire must be met before they'll even agree to pause fighting. Hamas wants Israel to accept a permanent ceasefire. Israel insists Hamas must be destroyed before the war can end. President Joe Biden is planning 2 meetings with Ukraine's Volodymyr Zelensky in the coming weeks. The US leader is seeking to telegraph solidarity with Kyiv in its war against Russia, despite plans to skip an upcoming peace summit in Switzerland. The president will meet Zelensky later this week in France on the sidelines of the 80th anniversary of D-Day in Normandy. A second meeting is planning the following week at the G7 summit in Italy.
Banknotes featuring King Charles III go into circulation in the UK from today. The Bank of England says the new notes will only be printed to replace those featuring the late Queen Elizabeth as they wear out. The polymer notes are designed to last at least 5 years, meaning cash featuring King Charles's image will remain rare for some time. Now, I have been entrusted with a couple of these notes. I mean, we say they're in circulation, but as we just suggested in that read there, there aren't going to be very many of them. King Charles flexing his environmental credentials. We won't see too many of these notes.
Yeah, because they're made of a polymer, aren't they? Which means they last. The £20 notes can last for up to 20 years.
Yes,
so
I thought it was interesting how they last almost as much as their face value by year. So
yes.
five as 10 to last 5
10 at
years.
10, 20 at 20. That's a nice synchronisation, isn't it? You put them in your pocket, put them in the wash.
Yes.
They should last. Apparently, you can post 300 quid in the post and then get these new ones, but I'm not sure if I trust the postal system.
I read this, Guy. I think this is really bad advice. I remember learning, you know, back when posting money was a thing, that you really don't post money. That sounds pretty daft. But apparently you can do that, or you can queue up and get £300 changed into these new notes if that excites you. But use of paper currency, of course, has been on the decline, and we've seen it. I was reading this morning, it's only about 15% in the UK of transactions are actually using cash.
I find it's really quaint that we're talking about money. How often do you actually use notes these days? It just seems to be something that we don't do anymore. I remember my grandmother posting me the occasional kind of £5 note in the post. That was a really big deal. So that was certainly a thing of the past. But fivers these days, £10 notes, how often do you actually end up using them? I think it's great that we still have paper money. I just can't remember the last time I used it.
I think I have to give these back to somebody.
Andrew Bailey, I think.
Yeah,
the Bank of England. He's just
I'll
across
run
the
over
road.
the road just after the show. Pop these back through the letterbox.
Maybe don't put 300 quid in the post. Guy Johnson. All right, coming up, why women's sport. Guy loves paper money. There we go. Why women's sport is attracting a growing number of investors. By the way, well done, England. England women's team beating France 2-1 in the qualifiers for 2025 Euros yesterday. We're going to head to Super Return in Berlin. Stay with us. This is Bloomberg.
Every single thing I've done
it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Deal flow in the first half of last year compared to the first half of this year, there's clearly a pickup in activity. There is also pressure on asset managers and sponsors to realize assets, to distribute money back to investors. There is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
That was David Hirschman, Permira Credit's co-head, speaking to Bloomberg at Super Return about the pickup in private equity deals. They also talked about defaults and higher for longer rates. Plenty more in that conversation as well. We will get back now to the themes around Super Return. The growth in audiences for women's sport is increasing the sector's attractiveness for investors, and private market investors have not let this go unnoticed. So let's join the dots then between private markets and sports. Let's get a sense of how big the appetite is. Our Markets Today co-anchor Kriti Gupta is at Super Return in Berlin with a guest. Kriti.
Yeah, Anna, thank you so much. Sports, women investment in sports is really, really important right now, especially in the broader macro environment. When we're looking for yields in different places, alternatives proves to be a really great part of that. I go even further, and you see that the women's sports investment have actually been growing thanks to, I would say, one of the front runners of that industry who joins me now this morning, Karen Nortman, co-founder of Monarch Collective and Angel City FC, which is, of course, a soccer team based out in L.A., also founded by, I believe, Natalie Portman, as well as a part of that investment base. Karen, a pleasure to have you at on the program and here in Berlin. We've got to talk about this. We've had Guy Johnson on a location in Berlin with the Euros behind him. Sports is a very exciting thing to talk about right now in the summer. You've got the Paris Olympics coming up as well. Talk to us about, from your perspective, coming out from LA with your background in tech, how you're approaching sports deal making on both sides of the Atlantic.
Yeah, well, listen, I think sports is a local business as much as it is a global business. And I think starting with a healthy respect for what are the local dynamics, and then how do you build essentially these global platforms that if you do it right, in the case of Angel City, we sell gear in our first year in 51 countries. But the way you show up is, the way I show up is I try to show up and listen and learn and help. And so we started Angel City officially in 2019. I'd been working on it since the 2015 Women's World Cup. And we kind of earned the right, I guess, to come over here and be helpful. You know, we have now on average 21,000 people attending our games. We sold out the last 4 or 5 and have done north of 30 million in revenue in our first 2 years out. And so when I show up in Europe, I come to speak, I come to help, I come to sit with teams and say, how do supporters groups look different in women's sports versus men's sports, and what's specific and unique to Everton, Liverpool, whatever the different teams, may be over in the UK or in Germany.
How are let's go granular here. We're going to kind of use sports as perhaps a way into talking about the consumer, specifically when it comes to things like ticket prices. Airfare has been a big conversation in the past couple of days out of our coverage of Dubai. Walk us through what you're seeing in terms of disposable income. How does that differ? What's your demographic?
Yeah, well, so I will say it starts with the heart, and then we get into the numbers, and I can move between the heart and the numbers, but these are the great cultural institutions of our time. It's the only place where people from 2 political parties sit next to each other and realize they have something in common before they don't. In terms of the consumer demographics, though, when you get into the nuts and bolts of the numbers, I think one of the interesting things about women's sports globally is ticket pricing is more accessible or affordable for everyday human beings. So I'll give you an example in the U.S. An average NBA ticket in Los Angeles is probably in the couple $100 range. At Angel City, it's $45. And so our demographics look a lot more like Los Angeles. They're about 40% 17 to 34-year-olds. It's pretty gender balanced, and it's one of the most fun entertainment products you can find. So you see a big difference in terms of building modern communities in women's sports, where price is accessible and even more accessible in Europe.
It's an interesting dynamic, and you have a background in tech. We should remind our international audience here. A deal making coming out of Silicon Valley, of course. How does that influence how you're viewing the deal flow right now? One of the big questions in this conference, but of course in the broader markets as well, is when are the capital markets going to open up? When is deal flow really going to pick up, as opposed to waiting for the other shoe to drop? Your thoughts?
Yeah, so deal flow in tech versus women's sports is very different, I would say. So in tech, there's always another investment. There's always another deal, and so there's this culture of trying to get in front of the best ones, coverage, how many did you see, what is your top of funnel? And of course we think about that in women's sports, but we at Monarch, where we do very few investments and we're very specific about who we like to work with and what we're trying to achieve, we really look at getting in front of deals months or years in advance, where we're helpful to the operators of that team, that league, those rights in advance. And so it really is about building trust around stakeholder dynamics and not waiting for things to fall on your lap, and being someone that is known, I think, globally as dependable and creative.
So in terms of months, years even, what does the pipeline look like for you? Again, this is coming in the context of the fact that people are saying the pipeline is looking strong right now in alternative investments. Everyone's excited about it. The mood here is very optimistic, almost to a point of concern. What does that pipeline look like for you?
Yeah, so by the way, we say we love to waste time with the right people, because it's not a waste of time. The pipeline looks incredibly strong, and it's really a matter of our own bandwidth and being thoughtful about where are we spending the many dozens of hours to build relationships. But I'd say it's much stronger than I even thought when I started Monarch with my partner Jasmine Robinson in 2023. And we are the first fund that's exclusively focused on women's sports in the world, Monarch Collective. When we started, we were looking at, I think the pace of kind of opportunities is dramatically accelerated in global football, which we call in the U.S. soccer, in women's basketball, in rugby, in cricket, in golf, in tennis. So we focus on media revenue-oriented sports, but they're not easy. And so the real hard part is actually doing very few things very well and getting those investments to convert into long-term partnerships. That takes months and months and hustle and hard work to do it with the right people.
Are you looking for partnerships in the UK, in Europe? What's your eye on?
Yeah, no, 100%. In fact, like one of our core values is around collaboration, and that's a hackneyed word, but I really think about this world as who do you want to build channel partnership relationships with? And so specific families that want to own teams, we can help new families get into business. Specific funds that have a different sort of value proposition than us, who value an all-female team who's operated deeply in women's sports. My partner comes out of the Niners, I come out of Angel City. So we are always looking to collaborate, and sports allows for it much more than tech. And you really have to build into the local ecosystem where people are going to show up and care.
Yeah, all right, very quickly, I'm putting you on the spot.
Okay.
What keeps you up at night? What's your worst nightmare?
Wow, the wrong people owning these great teams and not really valuing how deeply local and authentic these teams should be to bring meaning to people's lives.
All right. Karen Nortman, co-founder of Monarch Collective and, of course, founder of Angel City, the women's soccer team out of LA. We thank you so much. Really talking, Guy, about this idea that sports may be the new alternative investment. She's getting excited about it. She's got her eye on what's going on in Europe. We'll see how that all pans out.
Pretty exciting to see England beating France last night as well in women football, not soccer, football. We play it with our feet, so that was fantastic. Great conversation, Critty. It does seem as if it's all happening here in Berlin, but I want to take you over to Paris. We are going to get back to Super Return very, very shortly. We've got some great guests lined up. I have to say, Critty's booked some fantastic people to talk to. David Miller, Morgan Stanley's head of private credit, is going to be joining her really shortly. So just make sure you stay tuned for that conversation coming up. But I just want to take you to Paris, because I think we're getting a shot now of Joe Biden, the President of the United States, arriving in Paris. Air Force One has just touched down in the French capital. This is ahead of the D-Day anniversary. It is the 6th tomorrow. It is the 80th anniversary of D-Day. I have to say, I've been speaking to a lot of US executives, as I mentioned many times over the last few days. They are all heading to Normandy. They are all invested in this story. I was talking to Dave Calhoun about it yesterday. He was talking about his father's experience of D-Day. It's very personal to him. But he's talking about just kind of the parallels as to what is happening in Europe right now. Ed Bastian was talking about the same thing as well. Delta's going to be flying a whole load of veterans over the next few days, or has flown. But it's the arrival of the president here or over in France that obviously will be making the headlines. Some big conversations going to be happening around European security, guys. But they're all heading for Normandy. Tomorrow, obviously, a huge day, a commemoration of the 80th anniversary of the D-Day landings in Europe.
And it looks like the Beast is pulling up outside Air Force One in Paris as we await President Biden to walk down those steps and into that armoured car. Interestingly, you're talking about the CEO of Boeing. Boeing, of course, the manufacturer of the B-17 Flying Fortress, based in Suffolk and Norfolk. Of course, the 8th Air Force, their role that they played as well. So there's an interesting link there historically. June the 6th, of course, 1944, the D-Day landings, the most ambitious, the largest amphibious assault ever, World War II, of course. We are waiting for President Joe Biden. He will be heading there, currently looking to step off Air Force One in Paris, Anna.
Yeah, just trying to stabilise those pictures coming to us from Paris, but we are expecting to see the president land there. And as Guy pointed out, clearly the reality of European security right now will be something that plays heavily in the background of these 80th anniversary commemorations of Operation Overlord. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood is just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
This is Bloomberg. This is Bloomberg Markets Today, 43 minutes into a European trading session that shows a bounce from yesterday. Yesterday's sell-off induced by the energy sector, where weaker oil prices weighed on energy stocks. Today we turn around a little bit. Retail leading the pack. Those numbers from Inditex impressing some in the markets, it seems. US futures pointing a little bit higher, up 1 or 2 tenths of a percent. Now, this week, one of the big events we're looking ahead to, of course, is the ECB. It's ECB day tomorrow, and the central bank is expected to start cutting interest rates for the first time in almost 5 years. Markets are regarding the first cut as a given, but the path beyond June is still unclear. Let's bring in Bloomberg's Zoe Schneeweiss, who joins us from Frankfurt. And Zoe, we're building a picture of European data this morning, at least around the periphery and around some areas that are really showing a strong growth story, and that's around Spain and around Italy. We've got the Spain numbers waiting for Italy. I'm not sure if they move the dial particularly, but we're waiting for, is it confirmation of a rate cut from the ECB? Would that be to downplay its significance?
So we're getting these PMI numbers this morning. These are the second readings for Germany, France, and the euro area itself. And as a reminder, 2 weeks ago, when these numbers hit that and showed incredibly strong growth in these countries, this is private sector growth, those were one of the factors that helped markets recalibrate their rate bets going forward for the ECB. So tomorrow's rate cut is a given. That was well telegraphed, confirmed by almost all policymakers, including Lagarde, that should the data fit the bill, tomorrow will be that first cut. What happens afterwards is very unclear. And initially, another 2 cuts were very clearly a given, even some economists even thinking that there'd be more there. Now, that strong growth does let the ECB maybe think, how quickly do we need to move, and how quickly should we move?
Zoe, I'm just going to interrupt you briefly, and just because I want to take you back to Orly Airport in Paris, where the President of the United States has just touched down. He's just met Prime Minister Attal. They're chatting on the tarmac. The President in Europe for a number of different conversations, but clearly the objective of this trip is in Normandy and the anniversary that we are going to see tomorrow of D-Day, the 80th anniversary of D-Day. Obviously a huge moment, and given the politics, given the geopolitics, given what is happening in Ukraine right now, obviously highly germane to the conversation as well, a remembrance of the impact, particularly that the United States has had in Europe. So we'll continue to return to that, but as you can see, President Biden is on the ground in France and will be heading shortly for Normandy and the 80th anniversary of the D-Day landings. Zoe, let me just come back to you. We've also, just while we've been speaking as well, had the Italian May services data. That's down to 54.2. A little softer than maybe anticipated, but I want to talk to you about inflation. There is this growing narrative, and you've kind of referenced it a little bit already, that maybe actually this downward trajectory of inflation in Europe is beginning to stall out, and actually the trajectory may look more like what we've seen in the United States. How relevant is it to compare and contrast what we're seeing in the US right now to the European picture? And can I really, therefore, if we are talking about this, maybe suggest that the ECB can't go too far? And maybe the market is ahead of its skis in terms of what we're anticipating in terms of the total volume of rate cuts we're going to see from the ECB.
It's undisputed that on the way up.
Okay, I think we're having some connection issues with Zoe Genovese over in Frankfurt. Unfortunately, it does happen sometimes, live TV, talking, of course, about setting us up for the ECB, that decision, of course, tomorrow, the inflationary impacts, and whether there's a concern in terms of how the inflation story is evolving in Europe and what that could mean in terms of the synchronization of cuts from the ECB after the cut that is fully expected by markets and analysts tomorrow, of course, from the European Central Bank. Here's what else to watch out for today. 10 a.m. UK time, Euro area PPI, producer prices and PMI. Talking of the Eurozone and ECB, of course, that will build out the picture. We're getting the services data and the composite manufacturing as well out of Spain and Italy. Some strength coming through, particularly in Spain on the services front. We'll see how the picture in terms of PPI and PMI data out 10 a.m. builds on that story. 2:45 p.m. UK time. The Bank of Canada, that rate decision as well, could be a pivotal moment for the Central Bank of Canada. 3 p.m. UK time, we're going to get some more data out of the US, this time services, ISM Services Index. We know that manufacturing has come through a little softer out of the US. Then you had the job openings data, and we look ahead to non-farm payrolls on Friday. But 3 p.m. to mark on your diary is the services data, ISM, 3 p.m. UK time. And on the earnings story later, Dollar Tree, so a gauge maybe of the lower end in terms of the consumer impulse coming through on earnings on that front. Lululemon and Campbell's as well. Throughout the day, of course, we're also going to be bringing you coverage of the Super Return International event, the world's largest private equity event taking place in Berlin. Let's return to Markets Today co-anchor Kriti Gupta, talking of Super Return, who is standing by in Berlin with another guest. Kriti.
Tom, thank you. We started off the coverage this show with talking about one of the private credit investors. We have Premier on. We round out with some alternative investing in women's sports. Now we're bringing in the banking side of it. I'm pleased to say David Miller, head of private credit and equity over at Morgan Stanley Investment Management, joins me right here. Thank you so much for joining us on the program. Look, the theme of this conference, I talk to people over and over again, it's how excited they are about this deal flow. Private equity, private credit even, growing more and more, so much optimism. When does the party stop?
Yeah, I think it's important to put in context the size of the industry gets a lot of focus, particularly private credit. At $1.5 trillion, that seems pretty large, and that's grown over the last 10 years. But that's in the context of over 100 trillion of bank balance sheets, 100 trillion of equity market value, 100 trillion of fixed income. So the growth is, in that context, measured. You have 8 trillion of private equity. It has grown substantially, and private credit is actually following along. So I think it's natural as bank regulations have pushed more illiquid, riskier blending off balance sheet that you'll continue to see private credit grow overall.
There is a narrative right now that post-GFC, the banks in particular have taken a massive step back, especially from the private markets, really trying to eliminate some of that risk, and instead have kind of created a void basically for the likes of the bigger private equity specific firms to step in. What does that relationship look like in the future? Is it still more global Wall Street driven deals? Is it more private equity? Is it a combination? What does that look like?
Yeah, I think the ecosystem has changed a little bit. Certainly banks are more regulated, as they need to be. And so you've seen some of that risk go into private fund format, which overall I think has been good for the financial system. But there's also a complex set of relationships between banks and alternative lenders or private equity firms. And banks are still very much involved in that in terms of how they originate for the capital markets, how they provide advice. And so where we sit as part of Morgan Stanley, we're able as lenders to benefit from the deep relationships that our bankers and capital markets teams already have with companies and sponsors.
All right, so I want to go to deal structure in a second, but let's talk about valuations first.
Sure.
We're in an inflationary environment. There are concerns about stagflation on both sides of the Atlantic. There's also a concern about kind of a holdup within the private capital market space. What does that do to valuations? Given that you're talking about this optimism and this massive amount of new entrants to the space, are valuations now compressed? Does that mean valuations are higher? What does that look like, and is that the new normal?
It's a great question. So we've come in an environment the last 2 years, as you noted, where rates have come up pretty sharply. And so when rates come up, clearly that pressures valuations. So if you look at some of the older vintages going back to 2020 and 21, underwriting assumptions on multiple levels were fairly high. And so now we're in a reality where sellers want to maintain that high multiple, and buyers, not necessarily in this interest rate environment, are willing to pay that. Now that bid-ask spread has narrowed. It's narrowed in the last year. You're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
Well, that kind of holdup that you're seeing in the private markets, these lack of buyouts, for example, it's holding up a lot of money on the sidelines as well, to your point. Meanwhile, in Europe in particular, the leveraged loan market has opened up far more, I would argue, than the U.S. has as well. What does that do for European deal flow?
Yeah, I think European deal flow benefits from there being not just private credit. Last year was the only game in town for borrowers. Okay, and so with the broadly syndicated markets coming back, you're able to have options. And so for large deals, that's going to be the purview of the syndicated markets. But there's a huge amount of deal activity in the core middle market, say deal flow up to $1 billion in size. And that's still a very natural place for private credit providers to operate. I'll just give you a statistic. In Europe, over the last decade, the share of alternative lending and middle market lending has gone from 5% to over 50%, really as banks have withdrawn. And also investment banks have skewed their syndicated practice to be much larger. So we think those trends continue, and that will benefit the private credit providers.
When it comes then to some of the regulatory flow, you started off this conversation that kind of the deal flow coming off the GFC, a lot to do with regulation. There are concerns in the UK in particular that with a new potential Labour government in the works, there is a carried interest risk here. There's a higher tax regime. Even in the States, there's that question of what capital gains looks like in the next 12 months. Does that impact deal flow or appetite for it?
I don't think so. I think private equity has capital providers that are looking for returns. While it would influence the compensation of managers, I don't think that will stop them from looking for the best risk-adjusted returns out there for their LPs. So I don't think it affects deal flow. I think the biggest factor in deal flow is going to be economic growth and, to a second degree, interest rates.
All right, certainly something we're going to be keeping an eye on. David Miller, Head of Private Credit and Equity over at Morgan Stanley Investment Management, joining us from Super Return International this morning. Anna.
Kriti, thank you very much for that. Really interesting conversation there. Kriti Gupta joining us there from Super Return in Berlin. There's plenty more coming from Super Return throughout the day. Kriti on the ground, Danny Berger on the ground for us as well. So plenty of Team Bloomberg coverage. Among others, we'll be speaking to guests from THL, Brookfield, Ares and General Atlantic. So lots going on in Berlin. Tom?
Yeah, there's a lot going on in the semiconductor space. Part of that is linked to Berlin. Apollo, of course, coming in with that bid, or at least that stake, $11 billion stake in the business of Intel over in Ireland. Other deals coming through in terms of NPX as well over in Singapore, linked to TSMC, a business linked to TSMC. But also an update in terms of Honkai as well, because, of course, they are pushing aggressively around AI servers and building that out. They've come out with sales for May up 22%. So Honkai, also known as Foxconn, it's the contract maker for Apple, but is also now building out the hardware for the AI revolution, as some describe it at least. Honkai saying that the revenue for May was a record high for that month. Also saying that AI is driving the current quarter to beat expectations. So another kind of gauge point in terms of a touch point there in terms of the demand around AI.
Yes, and just just thinking about what we've learned through the program when it comes to priorities for deal makers. We've been on the ground at Super Return then, Guy. That's been taking place in Berlin. Some interesting lines about their assumptions on interest rates coming through there. But Guy, you're also in Berlin, just wrapping up a visit that's given you an interesting take on global business.
Yeah, we've over the last few days been to Dubai, been to Doha, been here in Berlin. I'm wrapping it up. Final aeroplane of the trip very shortly. I'll be back in the studio tomorrow. I'm going to leave Kriti Gupta here in Berlin. We'll see what she makes of the next couple of days. The football, the big theme, I have to say, here in Berlin. I'll leave you with maybe that thought, that the football story is about to kick off here in Europe. Is that going to give Europe the next big impulse? Maybe the ECB should be thinking about what the football story is going to be as well. We'll find that story out tomorrow. We'll leave you with the pulse. That's next. This is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Signs of a cooling U.S. labor market buoy Fed rate cut bets, while Treasury yields climbing after their largest two-day drop this year. The Indian Prime Minister Narendra Modi gears up for coalition talks after his party loses its parliamentary majority, while stocks rebound after yesterday's sell-off. And here in the UK, Rishi Sunak and Keir Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax plans. So there's quite a lot going on in today's markets. This is what the picture of European stocks look like. Now, the focus is firmly on data. We also have the ECB tomorrow. A couple of positioning ahead of not tomorrow, but maybe what they do at the next couple of meetings. Now, the ECB's inflation challenge, I guess, looks more and more like the Fed's, which is why we're seeing a repricing in some of the European bonds. European stocks, you can see on the screen, actually advancing. Again, because we've had signs of a cooling U.S. labor market, it does seem that it's changed what investors expect the Fed to do. In Asia, Indian stocks outperformed after an alliance partner of Prime Minister Modi's party affirmed support to form a coalition. Of course, government. Now, a couple of other things we're watching out for. Yesterday was a big day in UK politics ahead of the election, July 4th. You can see sterling 127.77, and then S&P futures gaining 0.1%. Again, traders are looking ahead to that expected reduction in interest rates from the ECB. And let's see what happens afterwards, because a policy path beyond this week's cut is probably unclear. So we're just telling you Treasury yields climbing further, or climbed as further signs of the U.S. labor market is cooling, and that's changing what we're expecting the Fed to do. Well, joining us now is Julian Salisbury, a co-chief investment officer of Sixth Street. Julian, as always, thank you so much for joining us. And it's an exciting week, actually. There's quite a lot going on. And again, it's all about the Fed and actually the ECB, the danger that central banks around the world will have the same problems that the Fed, which is maybe crying victory too soon.
Yeah, look, these, I think as all the central banks have said, they're going to be tracking data. I think it's pretty clear we're going to see the first cut from the ECB later this week. Our expectation remains that, notwithstanding that things are going to remain higher for longer. and that's going to put pressure on financing for corporates across the region.
So what does that mean for private markets? I know one of the big things that you're focusing on is the fact that actually because of the liquidity, available liquidity, some of the valuations, it's pushing more people to private markets.
Look, I'm very optimistic about the investment opportunity set for private markets in Europe. And there's really three things. One, just the size of these markets. There are many places around the world that are becoming harder to invest, more geopolitical risk. And notwithstanding certain election uncertainty and rate uncertainty you may see in Europe on a relative basis, this is a large investable market. Second thing, there's definitely a need for capital here. Growth capital for stimulating the software businesses and other growth companies that you're seeing across the region, healthcare, a huge need for infrastructure investment. And that's not just traditional investment in infrastructure, but other things. Some of the announcements you've seen this morning where corporates are looking for capital to help them stimulate nearshoring, reshoring, changing of supply chain. And finally, frankly, just from a supply-demand dynamic, there's always competition in markets, but on a relative basis, we see less capital here competing for deals on the private markets. And the public markets, the capital markets are frankly not as vibrant, and valuations aren't as rich. So you see many companies looking to the private markets as a viable alternative versus
and
public.
there's so many companies actually trying to get into private market. And the counterpoint is that actually it is a lot less liquid than public markets, and valuations sometimes are a little bit to be questioned. So when you look at private markets, where do you see the biggest value? Is it infrastructure? Is it real estate? Again, these are not assets that fall out of the sky.
First of all, I think there's always this erroneous view that liquidity and risk are correlated. There are plenty of illiquid things that are very safe, and there are plenty of very liquid things that are highly volatile and dangerous. So I think some of the safest, secure investments are some of the most illiquid. I mean, that's what we've seen over time, just great risk-adjusted returns in the private markets. In terms of valuations, look, I think the public markets are a great tool. They're a great discipline. It's a daily scorecard. It's a daily referendum on the business. And for some companies, it's a great form of capital.
Where do you see value in private market at the moment?
I think where private markets are better are looking through the long term. So if you have business, one of the things we're seeing right now is, for example, corporates who have an investment that they want to make, but it's going to have a drag on earnings. It's going to have a negative impact on their debt ratios. So they're looking to do that through off-balance sheet structures in order, recognizing that they're trying to thread the needle of earnings targets that a short-term driven public market investor is looking for, with more patient long-term capital. So you can look at businesses that are typically experiencing a J curve, or they may be like profitability may be many years away. And the private market investor can get deeper, they can get closer to the business, really understand it, and that's where they're able to extract value.
So again, what kind of assets are you looking for? So you're managing around 75 billion, I think, across growth equity, real estate, infrastructure, asset investing. Where do you see the biggest value right now?
I think here, I'd say three broad areas that we're spending time on in Europe. One is growth. Software has been a huge growth investments, growth companies. So software has been a huge investment theme for us from the beginning of the firm's history, really. But today, that remains a very vibrant and meaningful part of our business. Historically, it was the majority of our business. And while we're diversifying and doing other things, software and growth companies remains a very strong theme for us, both across lending and equity, up and down the capital structure. Really, one of the things I love about our business is we show up and we're not a hammer looking for a nail. We don't have a one-size-fits-all solution. It's, do you need senior lending? Do you need a convertible loan? Do you need pref equity? Do you need common equity? So growth, broadly defined. Second, on the infrastructure side, I think, I don't need to go through the numbers, but the needs for investment spend across digital transformation, decarbonization, deglobalization
This is across
massive.
The globe, or are you seeing better values?
Across the globe. I was in Asia 2 weeks ago, looking at investment around this exact theme. We're seeing it in the US. That's really a global phenomenon.
Space, I would say.
Look, these are big markets. And look, there are, on any given day, there are, tens of thousands of people that can buy an individual stock or bond. On most of these private situations, there are on any given one situation, there's less than a handful of people that are really there at the end of the day that can provide the solution that the company's looking for. And then, the third area, so we talked about growth, we talked about infrastructure. I'd say the third area is just like recapitalization. So there's rates are, not all, you saw quick adjustment in asset valuations when rates started hiking back in 2021 in public markets. You saw the growth equity reset very quickly. You saw other asset classes reset. I'd say there is definitely a longer bleed adjustment in other asset classes.
And more debt. Is it fair to say there's more debt in private market?
Yeah, absolutely.
And that hasn't played out yet. Does that mean there's opportunities or there's a bubble risk?
So I think there are, what we're seeing is companies that have debt maturities that they need to deal with. They can bring in more junior capital, pref equity to delever the balance sheet, allow them to turn out the rest. So live to fight another day. You've seen near-term extreme versions of this in the US. You had a lot of real estate where values reset dramatically because of the rate hike. You had relatively short-term debt capital structures. And in some cases like office, you also had fundamental underperformance in the underlying business. So they're needing to go through like extreme fits. I would say here, in Europe, it's less extreme. I think there's less short-term financing. It's not on the real estate side. It's not a vibrant environment, but it's not quite as acute as in the US. But I think you're going to see many companies look to amend and term out their capital structures over the next 2 to 3 years. So I think people often forget when you see these periods of turmoil that it's all going to happen very fast. Post Lehman. It took 4 to 5 years.
But so are you expecting a kind of Lehman moment at the moment? A Lehman moment?
Absolutely no.
That's like alarm bells. You say Lehman.
No. I'm just saying when we had that event, it took many years for all of the companies to restructure. And I would say what you've seen is companies that were maybe purchased and financed in a different rate environment. They're highly levered. I think that the reason I don't think it's I shouldn't have even used the L words. It will get people excited. The difference today versus then. I remember sitting here in Europe in 2008, huge asset liability mismatches and a tiny private market. And now you have so many larger. It's a very healthy thing for the economy. You have huge pools of private capital that can step in and help restructure when public markets aren't there.
Talk to me a bit about the UK. We have an election July 4th. Again, there's quite a lot of, I don't know whether there's opportunity in the UK because of some of the mismatches that we've seen in terms of policies, or whether it's just a country that you'd stay away from right now.
Perhaps I'm biased because I'm from the UK, but I continue to believe this is a great place to invest from a property rights, rule of law, entrepreneurialism, business mindset. I do hope that whatever the outcome of the election is, it's always hard when you go back in time. If you had known perfectly what the outcome of an election would have been, I'm not sure it would have been helped you that much as it relates to predicting the path of asset prices in the period shortly or in the subsequent years. But I hope whatever the outcome is, that policies are put in place that will encourage the development and strengthening of the financial services industry in the UK. I think it's one of the great strengths of this country. It has been, and I think we take it for granted sometimes.
So would you play it through software? Would you play it, again, is there anything at the moment that looks attractive for the UK asset, giving some of the possible transformation that we could see?
Look, I was at a dinner last night with a whole group of software CEOs and executives, and they're all very optimistic about their businesses. They're all looking for alternative forms of capital to grow and expand their businesses. I came away from that meeting quite optimistic about the opportunity for us in that space. And look, it's very easy to get pessimistic in the face of uncertain election outcomes, geopolitical risk, rate uncertainty. But again, this is one of the benefits of the private markets. You can kind of not get distracted by the short-term machinations, by the headlines, and you can really focus on the long-term growth potential over a 3, 5, 10-year time horizon.
Julian, thank you so much for joining us. Julian Salisbury there, Co-Chief Investment Officer at 6th Street. Now, coming up, Narendra Modi vows to stay on as India's Prime Minister despite his party losing its parliamentary majority. We'll bring you the details of that next, and this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back. Now, this week, we're, of course, keeping a very close eye on what we saw in India. Yesterday, we saw a lot of pressure on some of the Indian stocks, but also some of the bonds. Today, we're seeing a rebound after, of course, Narendra Modi said he will stay in power despite the coalition losing quite a lot. So Modi is now seeking to shore up his coalition to secure this third term. I guess investors think that that means that some of the reforms will continue to go through. So you can see the Sensex gaining 2.3% and the Nifty index 2.4% higher. Now, Narendra Modi, as we were saying, is vowing to stay on as Indian Prime Minister, even after his party lost its parliamentary majority in a stunning upset.
Today's victory is the victory of the world's largest democracy. This is the victory of unbreakable allegiance put into the Constitution of India. In our third term, this country will see a new chapter of big decisions. This is Modi's guarantee.
Well, let's get more on this story with Bloomberg senior India editor Menka Joshi. Menka, Modi's victory speech actually seems to have calmed markets.
Yes, it has, Francine. And one big reason is that clip that you played out, that victory speech that Modi gave last evening, in which he left no space for acknowledging any kind of loss or weakness and made it sound like a strength that he returned to power a third time. That seems to have calmed nerves a little bit. Of course, the shock value or shock effect of yesterday's election outcome also wearing off markets as they see both key allies of the BJP, that's Modi's party, reaffirm their loyalty to the coalition, and that suggests that there might be a stable government in the months to come, and that government would stick to the course that previous Modi governments have stuck to. And I think investors across the world, if you're not a portfolio investor and not looking to move your money very fast in and out, they will stand reassured by the fact that India's baseline GDP growth is expected to come in anywhere at 6.5% and more. We ended last year at over 7%. And I think they will feel confident about how this market shapes up, whether it's Apple or it's Samsung or it's GE. So I think things are coming back to normal after yesterday's shock results.
So what happens actually in terms of government formation? How long will it take? What kind of negotiations could we see?
Well, as I pointed out, the two key allies of the BJP have already reaffirmed their loyalty to that coalition, though, of course, they will be in negotiation to see what pound of flesh they can draw, given that, there is apparent weakness for Modi and the BJP. Now, the next date we'll be watching will be this weekend, when some media reports suggest that there might be the main swearing-in ceremony where Prime Minister Modi will be sworn in as Prime Minister. We'll know his cabinet formation then as key ministers are sworn in, and we'll also know what accommodation has been made for allies, and that will give us a sense of how confident the BJP is of holding this grouping together. It'll tell us who the key economic ministers are, and thereafter the next big cue will be the budget, because that will tell us what the revenue expectation and the expenditure pattern of this new government will be, how close it is to Modi 1.0 and 2.0, or whether Modi 3.0 tries to carve a very different path.
Thank you so much for joining us. I know you'll keep on top of this, and we'll get back to you throughout the day and throughout the week. Our senior India editor, Menaka Doshi. Now, President Joe Biden is planning 2 meetings with Ukraine's Volodymyr Zelensky in the coming weeks. The U.S. leader is seeking to show solidarity with Kyiv in its war against Russia, despite plans to skip an upcoming peace summit in Switzerland. Earlier this morning, the president arrived in France and will meet Zelensky this week on the sidelines of the 80th anniversary of D-Day in Normandy. A second meeting is planned the following week at the G7 summit in Italy. Well, coming up, it's a busy day for retail with Inditex earnings. Plus, we discuss how Birkenstock is actually convincing investors it's a luxury brand. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
see the supply chain improving, we keep ramping up. So the more they produce, the more we need, and we are very fortunate to have in front of us a very important backlog of orders to deliver. But that comes with higher rates if we want to be at the pace expected by customers, and therefore I think it will at least take 2 to 3 years to see a certain normalization.
Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan, it's not our regulator's plan. If we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror.
Well, that was the Airbus Chief Executive, Guillaume Faury, and the Boeing Chief Executive, Dave Calhoun, at the Berlin Aviation Summit with our Guy Johnson. Let's also turn to a top feature in Bloomberg Business Week called The Ballad of Birkenstock. Now, it explores how the 250-year-old German orthopedic shoe company transformed itself into a luxury behemoth with family drama at the top of management like a hit TV show, Succession. Now, shares up nearly 30% over the past month on robust earnings. The company also raised its forecast for the year as consumers snapped up its clogs and sandals. Let's discuss all of this with Andrea Felstedt from Bloomberg Opinion. I mean, it's unbelievable, right? This is like an old company for, it was an orthopedic shoe, and then you can't even get them online.
It's about the fashion cycle. These things go in and out. I mean, I can remember at least 3 times over the last sort of 30 years where Birkenstocks has been in and then it's been out. But I feel it's kind of transcended that now, and it's sort of an accepted part of our wardrobe. It really has become a fashion staple, and young and old, everybody wears Birkenstocks, and that's quite a difficult thing to achieve, and it's not universal. I mean, we've seen Dr. Martens have an absolutely terrible time on paper, same as Birkenstock, but it's had 5 profit warnings over the last year because it was a great hit. We had the chunky boot, was a big look 2 or 3 years ago, and then it faded. So it's quite a feat to keep it going.
But Andrea, so again, Birkenstock and Dr. Martens both listed. Birkenstock, has done very well since the IPO. Can they keep it going?
I think they probably can. I mean, it's been quite patchy since the IPO. It initially fell, and then it has recovered. I think if it can hold on to that fashion staple status, I think it can keep going. Whether it will be quite as strong, whether there will be times it's stronger, weaker, but I could see it carrying on.
I mean, in other fashion news, we have Shein that we're waiting for that IPO, and they've decided to list in London, and then there's also Inditex earnings.
That's right, and what we've seen with Inditex is it's almost become, it's not a high luxury brand, but it's become like an aspirational luxury brand because the true luxury brands have increased their prices so much. The mid-market has shrunk. You've got people like Banana Republic struggling, shrinking, so that sort of middle, clothes for work, etc., is sort of shrinking. Inditex has filled that void. It says it's not a deliberate policy, but it has stretched its price range upwards to meet that demand.
Andrea, thank you so much. As always, Andrea Felstedt there with everything retail. Coming up, the world's largest private equity event gets underway in Berlin. We speak to the co-chief executive of THL live from Super Return.
Every single thing I've done
it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Well, signs of a cooling U.S. labor market, boy Fed rate cut bets, Treasury yields climbing after their largest two-day drop this year. The Indian Prime Minister Narendra Modi gears up for coalition talks after his party loses parliamentary majority while stocks rebound after yesterday's sell-off. And here in the UK, Rishi Sunak and Keir Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax plans. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Intel has agreed to sell a 49% stake in a venture that controls a chip-making plant in Ireland to Apollo Global Management. The $11 billion deal actually brings in more funding for Intel's massive expansion of its factory network. Well, Bloomberg's Danny Berger spoke to Apollo's Scott Kleinman at the Super Return Private Equity Conference in Berlin earlier.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
Bloomberg brief anchor there, Danny Berger, speaking to Apollo's Scott Kleinman earlier. Now let's get back to Danny at the Super Return Private Equity Conference in Berlin with another great guest. Hi, Danny.
Hi, Francine. That's right. I'm pleased to say that we're going to continue a bit of the tech conversation. Joining me now is Scott Spearling, THL co-CEO. Scott, thank you so much for joining this morning.
Very welcome. My pleasure.
We're just hearing to Apollo talk about their fancy new deal with Intel and chips. So I want to start perhaps an older part of tech, software.
Yes.
There's been some wobbles there. Salesforce had some earnings that quite disappointed the market. Saw something similar from Workday. We saw Vista write down $3.5 billion on one of their online earning platforms.
Right.
What's happening?
So I think it's a matter of more managing expectations than anything fundamental. Software still is a really attractive business model with its high recurring revenue, long-term sticky business model. The expectation of infinite growth for the overall markets, and then specifically for growth within the market for certain companies, that probably has gotten ahead of itself. And I think part of it is the enthusiasm for the new technologies that are coming online, particularly generative AI, where the promise is always ahead of the reality. And it takes a while for the market to adjust, but then those realities will sometimes, in fact, oftentimes, come to bear.
We were talking about this, Jensen Huang saying recently, you got to spend more to save more in that CEO math. So when you're looking at companies, especially when you're looking at ones to buy, how much in your head are you thinking, is there an AI play here? How important is that make or break?
Yeah, we look at it as either a great opportunity or an incredible challenge. And sometimes it's both. And some of it is the uncertainty about how it all unfolds. Right now, we're seeing generative AI be a valuable tool for a lot of our companies that provide either automation services to a broad range of customers, whether it's a healthcare system or it's a factory floor or it's a distribution center. We see the ability to use generative AI as a way to reduce the cost of code creation because of the very nature of how it operates. But there's also, again, more promise than there is reality to a lot of the things that we've been talking about. And it's going to be a long time before we see how that settles out. The cost of running generative AI is also quite high when you think about the compute power that's often required. That's something that we don't talk as much about, but it is part of the business model element of a broad range of companies who are in this area.
Do you think tech investing needs to change to keep up with this idea? Because presumably there's a lot of companies out there, maybe CRMs, that could easily be disrupted by AI that, you know, this industry for a large part has liked those software deals.
And I think you're exactly right that there's a high risk of disruption of those business models. There's also the ability to look at what the implication for margin generation might be on more legacy or traditional businesses that now may use automated tools that may be generative AI based or not. For a lot of their business processes. So take accounting firms. There is a belief that this technology will allow you to do a lot more, particularly on the tax side, for individuals and corporations. Early on, that may be a significant cost savings for these companies that lead to excess margin. The question is, how much will their customers let them keep? And so there's there's a dynamic here that's yet to play out that we know presents, again, opportunities, but also could have severe disruption risk to some of these underlying business models.
Now, the other disruption risk, I just want to get to this, Scott, is regulation. And I know one area you're very active in is healthcare. Now, the healthcare space, I know this is more technology, more systems for healthcare, but there has been increased scrutiny on healthcare from regulators. Again, more so on the people side and roll-ups and staffing, so not exactly where you are. But I wonder if that overall regulation puts an ice on healthcare deals. Does it make you pause at all?
I think it increases the risk pretty significantly on some of these deals and the very nature of healthcare. So I have this night job as chair of the board of the Mass General Brigham System. So I'm looking at it now from a not-for-profit, an enormous $20 billion not-for-profit who does research and very high-end clinical. And they do unbelievable things that us mortals couldn't do. And, you know, it's really amazing. But the pressure, even on that not-for-profit, because nobody wants to reimburse to really truly cover the cost, is enormous. So if you're a for-profit going into this, you're trying to pick off the best payer mix. You want commercial payers as opposed to government payers. You want to do things that are going to drive the margin of your business up in ways that may not be as patient-friendly as what some not-for-profits do, all in an environment where the government wants to continue to squeeze the amount they spend on healthcare. And so that leads to a very difficult formula if you're in some of these for-profit players, and creates the political risks that we're now seeing manifest in the things that you're hearing from the Elizabeth Warrens and others of the world.
Scott, I do want to end here because it has been over a year since Thomas H. Lee passed away, your founder and someone you cut your teeth under. I mean, he started leverage buyouts before leverage buyout was even a word.
Right, a real pioneer.
A real pioneer. And again, the times were different then, and leverage has become another hot button issue because of where rates are. I wonder if you look at sort of the foundation of THL and where we are now and the concerns about leverage, is this a paradigm shift?
So the paradigm shift, Tom left us really in 1999. And then without economic interest starting around the mid-2000s. So the business, when Tom was with us, and he started Real Pioneer, the firm, focused on growth buyouts, mid-market growth buyouts, which at the time was unusual. That part, the culture that he created still exists in the firm. But the difference is we've grown dramatically because the very nature of what we need to do to generate the kind of strong returns we're aiming for has changed dramatically. So we have much more specialized expertise in the areas that we invest. We have significant investment in operating expertise. And this is true for a number of people in the industry. I think I'm characterizing more generally. But certainly I know from our firm, when you go from 30 people to 150 people, it's a very different world. And I think leverage is not as impactful as it was. The business models that we're seeing today, the impact comes really from the growth in EBITDA, the ability to manage to a acceleration in growth rates where you earn multiple expansion is a very important element of how we think about the business. And when you look at the capital structures that are now very equity intensive, it's a very different world than when I started 40 some odd years ago and you were putting up 10% of the deal in equity.
Right. Well, I mean, it's also a higher for longer world. Scott, unfortunately, we don't have time to get into that because that would take us another hour. But thank you so much for joining. Really appreciate
you are very
it.
welcome.
Francine, that is Scott Spearling, the THL co-chief executive, looking at everything from AI to higher for longer for a bit there.
There you go, AI to higher for longer. Danny, great work as always with Scott. Now we'll have plenty more from Super Return throughout the day. Plenty more, of course, great guests joining us. Anuj Ranjan, the Chief Executive of Private Equity at Brookfield Asset Management, Ares Management Partner Matthew Tiertnell, and General Electric Co-President Gabriel Caillou, just amongst some that will be joining us throughout the day. Coming up, Rishi Sunak and Keir Starmer face off in the first TV debate of the UK general election, trading barbs over their rivals' tax plans. More analysis next, and this is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide crate index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Now to the UK election campaign, where Prime Minister Rishi Sunak and Labour's Keir Starmer clashed over taxes in the first TV debate of the campaign.
We will raise specific taxes, and we've been really clear what they are. We've already dealt with the tax break on private schools. We want to end the non-dom status completely. I think that the super rich should be paying their tax.
Independent Treasury civil servants have costed Labour's policies, and it's £2,000. But you asked for specifics, really. So let's have a specific difference.
Please let
I've
Mr. Sunak
announced
finish.
The triple lock plus, so that we raise the personal allowance for pensioners and ensure that the state pension is never subject to tax. That's what you'll get under a future Conservative government. Keir Starmer hasn't matched that pledge, which means for the first time in our country's history, if Labour are elected, pensioners will pay tax. I do not think that is right.
Well, let's get more on all of this with Bloomberg's Carla Canavet. Carla, thank you for joining us. It was an interesting debate. I thought it was a good debate. Who came out on top?
So that's always the question you have coming out of those. And in this case, I actually think there's something for everyone to take. The immediate snap poll right after the debate ended was giving a very small victory to Sunak with 51 over 49 against Starmer. So at the looks of it, at first blush, that would be a really tiny win for Sunak. But I do think that there's two other ways of looking into it. The one is Sunak is the prime minister, the sitting prime minister, who is coming into the debate with an over 20-point
disadvantage. Yeah, so it doesn't change the polls. This was basically a poll on how they did in the specific debate. It doesn't necessarily change the poll on how people vote.
No, I think in that respect, there wasn't really anything to move the needle. And again, it's good that the one going in defeated in the polls gets a lead, but also for Starmer, it's a matter of he already has the lead. He just has to keep it. Right. So that can also be seen as a win for it. But in terms of, did anyone win the election on that night? No, I don't think anyone did.
Sunak's main attack was that Starmer would raise taxes. Did he land any blows?
Yeah, he did. I think his biggest blows were in terms of the NHS. And the big one was that in the track record, Sunak at some point was trying to defend that the waiting lists are going down, they're improving, and Starmer obviously latched onto that to say, well, in fact, while they are now coming down a little bit, they are still higher than when you first made the promise to make it better. So I think that was one of the best ones for him.
Carla, thank you so much for joining us. That was Carla Canavet, of course, joining us with the very latest on that debate. Now, look at this. We have the King Charles banknotes, and they're entering circulation today. So where can you get them? At some post offices, but only a few because they'll be very gradually changed. The sovereign is being changed on the Bank of England's notes for the first time. We knew that there was actually a line in front of the Bank of England today. The portrait that you can see here of Charles is appearing on all four banknotes, the £5, £10, £20, and £50, with no other alterations to the existing designs. But it will be a very gradual change. Several post offices, for example, in London are issuing the new notes today. Now, coming up, we also discuss the UK housing market and the mortgage sector with the chief executive of Skipton. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, You know, movie going begets movie going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Most products are priced according to the value they bring. And I feel really good about the value of our medicines, what they bring to the individual patient, but also the value to the healthcare system. And we have today healthcare systems around the world who were typically designed for acute care, but finding that 80% of the cost in the healthcare system is linked to chronic care. And we have a portfolio of products that are really addressing some of the chronic diseases of our day and age.
Well, that was Lars Fruergaard Jorgensen, Chief Executive of Europe's most valuable company, Novo Nordisk, on the pricing of its blockbuster diabetes and obesity drugs, Ozempic and Wegovy. You can see that full interview on Leaders with Lacroix airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now back to the UK and rate cut expectations for the Fed, the ECB and the Bank of England have all pulled back in the face of stronger economic data and sticky inflation. Now, it could impact the recovery of house prices here in the UK 1 month out from the country's general election. Let's discuss all of this with Stuart Hare, Chief Executive of Skipton, one of the largest building societies in the UK, with consolidated total assets of around £37 billion. Stuart, thank you so much for coming on. There's so much appetite to understand what the mortgage markets look like, what it means for Skipton, and of course what happens in this general election. First of all, the housing markets appear to be stalling as the Bank of England hasn't cut yet. So how do you see that developing?
Well, alongside the Building Society, we also own the UK's biggest estate agency. So we see some real-time data. And what that tells us is that actually demand is up year on year. Now, it was a quiet year last year. It's up about 20%. And that's because people are readjusting their expectations of what they can buy in the face of probably longer interest rates.
And so do you see a pattern depending on where in the country you're looking at?
Yeah, in London, for example, the rental market's going nuts. You're also,
that's a technical term.
A technical term. You're also seeing house buying, the number of house buyers in London starting to pick up as well. But it's actually a relatively broad swathe across the country. It's more affordable outside of London, which means there's more activity picking up there now as well.
So, Stuart, what's your outlook for house prices?
House prices, we think, will stay around the level they're at for the next 12 to 18 months, and then gradually start to pick up to the long-term trend.
And so you launched the first 100% non-deposit mortgage also since 2008. How has the uptake been on that?
It's been fantastic, actually, across our whole first-time buyer range. We lifted ourselves to helping over 20,000 people last year. That was up 70%. So we're feeling pretty good about first-time buyers. And indeed, the market overall, we're seeing more first-time buyer transactions than we've ever seen. 1 in 3 transactions in the UK are to first-time buyers.
So more lenders appear to be extending terms also to 30 years and beyond. Again, are there any risks to the mortgage market because of that?
Of course, yeah. I mean, basically, you're making debt last longer. That can mean that it's more expensive over the longer term. But it allows people to step onto the housing ladder, and then as their finances improve, they can actually adjust that term down as they progress through the mortgage.
But that's here to stay. It'll be 30 years or above.
So. I think look, house prices have inflated beyond income. Yeah. And that means that they become that bit more unaffordable. Yeah. So to get on the housing ladder, to be able to put that nail in the wall, which a lot of Brits aspire to, then they're having to make different financing arrangements.
Stuart, talk to me a little bit about what kind of policy you would like to see from the government after the election.
We're chronically, in the UK, we have a chronic shortage of houses. There's actually less houses per 1,000 people in the UK than there is in France, there is in Italy, across the whole of the OECD. So we need to build more houses, full stop. Yeah. But we need more social housing. So we need to support planning rules that build social housing, private rental sector housing, and residential housing for purchase. So overall, we just need more houses built. So anything that supports planning reform is really important to us.
Stuart, why has it been so difficult? Because everyone's fully aware of it. This is one of the policies that was telegraphed from the start.
Absolutely, but it's been telegraphed from the start, but we haven't had supportive policies around bringing capital into the housing market. We've had an awful lot of rules, planning rules created, and also local councils with planning departments that have been decimated. So we need some concerted policies. We probably want a politician, a housing minister in role for a very long time as well, so that those policies can turn into reality.
Do you see the industry of real estate actually, real estaters changing? I know there's been a bit of consolidation. There's more also like independent websites that are coming up.
I'm exceptionally proud of the work that our guys do. 1 in 10 of the houses bought and sold in the UK is done through us. But we are ultimately concierge of quite a difficult process. And I think digitisation can play a part alongside the great humans that can help sell your houses. So I do see technology coming in there. I also see more vertical integration. So the whole home buying and home selling journey can be done through one operation.
I mean, what's the one thing that people ask you at dinner parties? Because you're like the mortgage expert, and everyone's obsessed with house prices.
Yeah, I mean, everyone that has a house is obsessed with their house price not devaluing. Anyone that doesn't have it is when's it going to be
Want them to go down.
Yeah, so it's how stable is the housing market. And for me, as a 100-year bet, it's one of the best asset classes the UK's ever produced.
Are you surprised that we didn't see more defaults, given where interest rates have gone? Defaults or just anxiousness in the mortgage market?
Bluntly, yes. A little bit surprised on the upside. Now, that's a good thing. But don't forget, lenders have been stressing affordability for over 10 years now. So it's not just being able to afford the mortgage payments now, but potential increases. So there has been a cushion in household finances. But, for example, in the last couple of months, we've actually seen arrears coming down. So we're seeing people better able to adjust. But it does mean that some of their other consumption has had to reduce down as well to be able to afford those payments.
When you look at the last 18 months, again, there's been, the high-end property market has changed quite a lot. Will it change with some of the rules coming into place on non-doms, or do you think that's actually untouchable?
It's a very resilient market, London, for example. So we have 2 estate agents in London, John D. Wood and Hamptons, and what we've seen there is actually increased demand. London's considered a safe haven. It's a great place to come, it's a great place to visit in the summer, it's a great place to shop. And there is an awful lot of serious foreign money that is always interested in buying properties alongside aspirational Brits.
Do you think, is it really true that they say actually the mortgage market or house prices decides an election?
I don't think it decides an election. I think it plays a part, but it's to do with the impact it has both on the psychology of the UK and the economy. Because if there's an awful lot of houses being bought and sold, then there's an awful lot of people bringing tradesmen in, there's an awful lot of people doing work, and it actually lifts economic activity, and it also lifts spirits.
But go ahead.
And I think generationally there is a real challenge for politicians just now, because I think there's a sort of trap whereby those with houses don't particularly want to see too many more houses built around them. But there's an awful lot of younger people who don't have the same opportunities that I had when I was younger to be able to buy a house.
Stuart, thank you so much. That was a wonderful update on the housing market. Stuart Hare, their Chief Executive of Skipton Building Society. Now, up next, Bloomberg Brief. Manus Karani is in New York. Danny Berger, of course, is in Berlin at Super Return. So they'll talk about markets, private markets, and there's a lot going on in India as well, with Indian assets finally after the slam dunk that they had yesterday, getting up a little bit. This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big, American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranny. Danny Berger's on the road in Berlin, speaking to the private equity titans. Welcome to Bloomberg Brief. Let's set your agenda. Apollo strikes an $11 billion venture deal with Intel. Co-president Scott Kleinman says they're just getting started.
Yes.
More from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Round two, Elliott Management targets SoftBank a second time, pushing for a $15 billion buyback, according to the FT. And super return is in full swing. We'll hear from the top voices in private equity as Danny grills them on the ground in Berlin. A very good morning. You've had a lot of data to absorb, and that has bolstered the equity market within 0.6% of a record high. Yields dropped, stocks did the needful. And again, it was a little bit of a drag on the equity market, was the energy complex down by 2% as oil trades down to a 4-month low, down an eighth of 1%. Inventories are building in the API data and indeed at Cushing. So oil trades at a 4-month low. RBC reminds us, Halima Croft reminds us, OPEC has not abandoned their active management. The taper, as they say, is an aspirational taper, but oil is down for the 5th day in a row. So that's the drag. That's the offer on the S&P 500. The bid on the S&P 500 is Intel at the bottom of your screen. Apollo doing an $11 billion deal to buy 49% of a joint venture stake in Ireland, and more of those deals will be done. Yields, as you can see, they're doing the needful. Yesterday, we saw job openings at the lowest in 3 years. JP Morgan's survey showed the longs are the highest since March, going into this jobs report over the space of the week. 5, 10, and 30 are all down by 15 basis points. We're going to talk more about the job market, I'm sure, with Amy Wu Silverman in just a moment. They've released her to her native environment to super return in Berlin. And the news gods are good to you. I'm envious. Good morning, Danny. How are you? What's the big story?
Good morning, Manus. I'm good. Well, okay, we got one big story. Apollo, $11 billion deals with Intel, as you mentioned. We got the exclusive. We had the first interview with Apollo. The message man is more is to come. I know we're going to talk about that later in the show. But for everyone else here, it's fascinating that the concentration of the market is something you and I talk about all the time. It's that it's big cap tech leading this market. And for folks here who want to IPO, unless you have something that can match an NVIDIA, it's not an easy environment to do that. So it's getting tougher for exits, despite the fact they're doing more deals, like, again, the one Apollo did, $11 billion, Manus.
Do you get the sense that the gap between the two, between the investors and indeed the asset managers, is closing, Danny? Who have you got set up that you can prod on this topic?
I was going to say I have two great guests that we're going to be prodding on exactly this. Coming up in about 10 minutes' time, we're going to be speaking with Anuj Ranjan, the Brookfield Private Equity CEO, and Matt Swertnia. He is the Ares head of private equity. Don't worry, Manus. I'm going to be grilling them both on this topic exactly. The feeling does seem to be that it is starting to shrink, but the dam might break.
Okay, well, if anybody can break a little bit of news out of this lot, you can. Enjoy yourself. We'll hear more from Apollo when I see you in a little while, and we look forward to those interviews. Danny Berger at Super Return in Berlin. So Danny has the Apollo Intel deal to deal with. We've got SAP in Germany agreeing to buy Walkame for $14 a share. This will be a cash deal. Walkame is expected to close in the third quarter of this year, and it will have an immaterial impact on their reporting. So this is SAP, as you can see, up 0.6%. There really is this sort of frenzy around the whole tech sector at the moment. And it's an intention to buy this. We've also got a little bit more news for you on Dollar Tree, a potential sale or a spin-off of Family Dollar. Now, this is according to the Wall Street Journey. There is Walkame and SAP. We'll see how that deal and how the market takes a hold of that. Business transformation by enhancing customer experience, enriching SAP business in the AI space. The magic dust. It's almost like going for a burger at Salt Bay. The magic dust. AI. If that's in the title, you're rocking. Or not, as the case may be. Well, yields, they're doing the job. We had the latest jobs data showing the lowest openings in the JOLTS number since 2021, boosting the bets that the Fed cuts will come sooner and in more size. Connor Cooper is with me. Today, it's all about the ISM data, and it's not been a good week, has it, so far for the data? It's amazing how we've almost sort of done a 180 from last week, higher for longer, rate hikes from some of the Fed speakers were intimated. Here we are. Suddenly, the dual mandate comes alive. Good morning.
Morning, Manish. Yeah, it hasn't been a good week for US data. We started with that down revision to first quarter GDP. We had a slightly softer personal spending number on Friday. ISM manufacturing missed on Monday. JOLTS was soft on Tuesday. And we've got the ISM services number to contend with later on today. Did have a check on the terminal this morning. The ISM services number, it's actually missed expectations in 4 of the last 5 months. And that does include the last 3. So we'll be watching that number closely this afternoon.
So I'm looking at the euro dollar at the moment. We had HSBC with Darren Maher with me yesterday morning, and I think he sort of said it 3 times. I'm short euro, I'm short euro dollar, I'm short euro dollar. Look, it seems to be all in the price, 108.74. The debate is going to be is how dovish Lagarde is in terms of keeping the July rate cut dream alive. And they're not under as much pressure as they were even just a month ago.
No, the ECB's been pretty clear. They've telegraphed a 25 basis point move, and markets and economists have both listened pretty carefully. Market pricing implies a near 100% chance to get a rate cut tomorrow. Economists are almost unanimous in their view that we'll get the same. So a bit of a non-event in terms of the rate move. There's going to be more focus on the forward guidance that we get from Lagarde. I think that's where the key from tomorrow's meeting will be. Is the ECB to cut rates again, or is this a one-and-wait approach from the ECB? Market pricing suggests that there'll be a pause in July as well. And I don't think that's a bad position for the ECB to be in. If they hike tomorrow and pause in July, that gives them to September to gather more data, especially on wages, which we're told is key, and then they can make that decision. I imagine any comments on the path of rates to Lagarde tomorrow will get a pretty boring answer centred around data dependence.
Yeah, well, they love a bit. Everybody loves a bit of data dependence. But don't worry, we've got OPEC Plus now, the Central Bank of Oil, with their forward guidance being very, very clear, and the market's disappointed. Connor, thank you very much. Connor Cooper there, setting up the agenda. We count down to those services numbers. In our headlines, we talked about the activist investor, Elliott Management, rebuilding a sizable stake in SoftBank, pushing for $15 billion buyback. That's according to the FT in their reporting. Tom McKenzie is with me. Round two for a punch-up. They did this before, and one could say that Elliott did bring Masayoshi Son to heel before. So why take a second swipe at SoftBank?
You're absolutely right. Second time round for Elliott when it comes to the story of SoftBank. They piled in 2020 with a bet of around $3 billion US. They pressured SoftBank into issuing buybacks. That happened. Then they pulled out of the trade. They sold down. They sat pretty on the back of that trade. That worked out for them. Now they're trying again. And the rationale for this is that there is a gap, a screaming market gap in terms of the market value of SoftBank and its underlying assets. In fact, it's something that Masayoshi Son of SoftBank has been talking about himself. Elliott want them to go through with buybacks then of around $15 billion US. They say that will signal Masayoshi Son his own confidence in this business. That's what they're pushing for. That they say the time is right now. This is a business, SoftBank, of course, has been walking back some of those investments in tech, of course, some of those ones that went wrong for SoftBank, like WeWork, for example. But they are now looking, SoftBank is now looking aggressively at AI, and of course they have exposure to part of that through their holdings in ARM, which has worked out pretty well for them.
I mean, this is maybe where Masayoshi Son, my apologies on the mispronunciation the first time round, you know, he's maybe got a better case to push back against Elliott this time. In other words, if you want me to develop SoftBank and you want me to have those AI investments, I want to use my dry powder, and it is a sizable scale of dry powder for deploying on opportunities rather than buybacks. It's the classic kind of counter defense, isn't it? What size of dry powder do they have?
Around 6 trillion yen, that's about $40 billion US, about $40 billion US. And look, you're absolutely right. We know through Bloomberg reporting that Masayoshi Son has been in discussions about raising up to $100 billion US to build out a competitor to NVIDIA. I mean, the ambition is there, a hugely ambitious project, but it would require that much capital. So they're still 60 billion short of that. They're also looking at maybe buying the UK chip company Graphcore. So that would be the pushback. We need this capital, as you say, to invest around AI. The stock is up 50% year to date, and it's still not at those 2021 highs.
Tom, thank you very much. Tom McKenzie there on the very latest. The battle between Elliott and SoftBank. Other top stories on your Bloomberg terminal this Wednesday morning. BlackRock and Citadel are among the investors backing a Texas upstart will challenge the New York Stock Exchange and NASDAQ. The Texas Stock Exchange has raised $120 million, and it plans to register with the SEC. The CEO, James Lee, told the Wall Street Journal that the plan is to entice companies seeking relief from the increasing compliance costs in New York. NXP is teaming up with a company partly owned by TSMC to build a chip wafer plant in Singapore. A $7.8 billion plant will be built in the second half of this year, with production starting in 2027. Southeast Asia is emerging as a force in the technology manufacturing and as a global tech firm diversifying from China. eBay is dropping American Express cards as a payment option. The online marketplace says it's no longer accepting Amex because of unacceptably high fees. eBay plans to notify customers this week about the change, which is set to take effect August 17th. Coming up, we head back to the Super Return Conference in Berlin. The CEO of Brookfield Private Equity sits down with Danny Berger. Context matters on Bloomberg.
other authorities.
Could face bigger challenges. Britain's next.
Was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Brief. A very good morning. I'm Menace Granny in New York. Danny Berger is on location in Berlin, where we go live. She's at the Super Return Conference. Danny, what have you got?
Did you say I was on vacation, Manus? We are hard at work over here. Don't let some of the nice greenery behind us fool you. But we are hard at work, and we're talking with someone else who has also been hard at work. Meeting after meeting, he took some time for us. It is Anuj Ranjan, Chief Executive Officer of Brookfield's Private Equity Group and Brookfield Business Partners. Anuj, thank you so much for joining this morning. I had to look down for your title because you've got a new title now. First time joining us since the promotion. So first of all, congratulations on that.
Thank you, thank you.
And I know when that announcement was made, you made a very clear statement. Look, we're going to scale up this business. It's an interesting time in this industry. There's concerns about can you exit, concerns about higher for longer. So why is now the time to scale up private equity at Brookfield?
Well, first of all, thank you for having me back. I'm very fortunate because I've stepped into this role at a time where our private equity group is at a true inflection point at Brookfield. And I genuinely think we can triple the size of this business in the next 5 years. We have everything in place. We've got the best team we've ever had. We have real boots on the ground, operational capability in every market in the world that we invest in. An incredible track record. We've been doing this for 25 years. So I'm very fortunate to step into this sort of opportunity at a time when we've got this platform that I can hopefully help grow and steer into the right direction.
So just to make sure I heard you right, triple in 5 years.
That's right.
What leads that?
You know, it's funny. Of course, the deal environment is not as exuberant as it was in 2021 or 2020, but activity's back. Good sponsors that are buying good businesses to generate cash flow, ones that have sort of an angle to bring a real operational capability to the businesses that they own. They can get financing, and that financing is enabling a deal environment where transactions are happening. We think that it's back to roll up your sleeves private equity, and you really have to get into a business and improve the margins rather than relying on multiple expansion to generate your returns.
Right, the financial engineering part of it being over. Well, so that's kind of the deal structure, but what about region? Is there a specific region you're leaning into?
So we've always been very big in North America and Western Europe. Those continue to be two key regions for us. In the rest of the world, India and the Middle East has always been very important. We continue to find great opportunities there in Australia. But we're seeing opportunities around the world. The United States is quite interesting because it's been very resilient. Our businesses are performing very well, even in the last 12 months. Market leaders continue to be able to set pricing and to be able to pass through inflation and handle this environment quite well. So we're going to continue to focus on the core things that we do, which are industrials and essential services in the United States and Western Europe.
When it comes to industrials, though, I mean, again, it's, you know, the companies that Brookfield traditionally invest in, but they tend to be capital heavy, and we're at a time when growth is compressed. Is the macro environment becoming more challenging for industrials?
You know, I'd say it's becoming more rational. And it's becoming, you know, I'm actually glad that some of the exuberance is gone. I think it's a healthy market. Financing is available. We've financed almost $20 billion of debt, refinanced in our portfolio companies at often the same cost or less than what we had before. So you can get great financing for great businesses, again, if you're a great owner of that business. So, you know, I think that this environment's actually quite healthy. Industrial companies, if they are market leaders, they provide an essential product or service, they can still thrive in this environment. And, you know, again, it comes back to really going into these businesses, rolling up your sleeves, and relying on margin expansion, not multiple expansion, to make your returns. And I think even at this conference, that's, I think, a realization across the industry.
The other thing, though, that's been talked about this conference is, sure, there are deals to be done. There's some attractive things out here, but the selling isn't happening. The selling is still at a standstill. LPs are not happy about that, especially as you're extending the business. Do you have to have a clear view with exits? How do you handle this conundrum?
Look, we always say if you're not selling a business at a certain price, you're buying it at that price. And that might be okay for a great business that has a lot of runway ahead, but you have to constantly be thinking about exits. We think about exit from the time we make an investment.
Right.
And as the largest LP in our funds ourselves as Brookfield from the balance sheet, we really care about that DPI or that return to our partners as well. And so that focus is throughout the business. We've actually managed to make quite a few exits in the last 12 months, notwithstanding this current environment. We sold a business in Europe to a strategic. We sold a business in Asia to another sponsor. And of course, we had a big exit of a large business in the US, which again was sold to a strategic. So there are exits happening. I think it's about the types of businesses. These are high cash yielding, really market-leading businesses that people want.
But there's some stuff out there that this industry has done, especially when there was that period of time where rates were low, that everything was bought at high multiples. Anuj, there's things out there that are not quality companies.
Absolutely.
When do those get sold, and what does it look like when they do?
It's thankfully I don't think we own any of those, so I think we're not in that challenge. But there are people that depended on a low rate environment to get exits. And I don't think that low-rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing. Some of the businesses that relied too much on unprofitable growth are going to have challenges getting exits, frankly, at any price, at any time in this environment.
Anuj, I want to end here because you have global experience. Brookfield has led you all over the place. You've started up many businesses, and I know you were in the Middle East for a while. The Middle East is obviously, and the sovereign wealth funds, has been a very fertile ground for fundraising. There does seem to be this concern, though, that if you look at the PIF, for example, that they want to start spending more internally. They have a lot of projects they want to put money towards. Do you think some of the fundraising slows down from some of the Middle Eastern sovereign wealth funds as they look internally?
Look, I think it's all relative. I think the Middle East has been a huge supporter of the industry and provided a lot of capital globally over the last decade, and they will continue to. They will continue to be a big supporter of ours, and I think of the industry. They do have a focus also on investing in the country. We've been investing in the country for 10 years. We've done about $10 billion of deals in the Middle East. And in fact, we're really excited about that market. We think it's been very, very valuable for us. It's been great returns. We think of it as kind of emerging market returns with developed market risk. And so we'll keep investing locally, and some of them will partner with us in that region.
What's competition gotten like there, though? Because when you started there weren't a lot of players there. There was a recent story on Bloomberg, our colleagues writing that Chinese investors are also increasingly getting interested in the Middle East.
Absolutely. Look, Asia and Middle East broader are all interested in that region. We're seeing, though, that a lot of them want to actually partner with us because not everyone has the boots on the ground, and it comes back to that operational capability. We've been in the Middle East since '97, been an active investor since 2015. We got a big operating capability locally. We don't invest in the region from London or from another market. We invest from that market. And hopefully all this capital that wants access to it will find partners like us valuable.
Anuj, thank you so much for joining this morning. It is always a pleasure to hear from you. Come join us when you're next in New York. That is Anuj Ranjan of Brookfield. More ahead from Berlin. Manus is also going to walk you through the news you need to know this morning here on Bloomberg Brief.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It is Bloomberg Brief. I'm Manus Granny in New York. Danny Berger is on location in Berlin. The oil market holding near 4-month low amid increased stockpiles here in the U.S., according to an industry report. That is adding to the bearish sentiment, compounded by OPEC Plus's plan to boost supply. Let's get to our executive editor for commodities. It is Will Kennedy. So the stockpiles are rising, and this market is still chewing the OPEC Plus deal like a wasp. Halima Croft says it's an aspirational cut. This market is fixated with additional supply. Will, good morning.
Good morning, Manus. And I think, yes, like all OPEC decisions, there are options for adjustment down the line if they decide to do that. But I think it is clear that the broader picture of the meeting was that to maintain the group's unity, some of the members wanted the ability, the UAE notable among them, to start putting more oil back into the market into 2025, and that is what's going to happen. I think it would be hard to put that genie back into the bottle, and the modest market move that we've seen, it hasn't been a crash, there's been a sell-off. That market move, I think, has been driven by the realization that they are going to get more oil as we get into the latter part of the year and into early 2025. The big question, of course, is the demand picture. Will the global oil market be able to soak up that supply? It's been very robust over the last couple of years coming out of the pandemic. Will that continue? Of course, lower prices are a big, big benefit for Joe Biden as he goes into an election.
Absolutely. Those gas pump prices equal votes. Will, thank you very much. Tucking it up very neatly and compactly. Will Kennedy, our executive editor on commodities. We'll be catching up with RBC's Amy Wu Silverman in just a moment to talk about vol.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
From our global headquarters in New York, I'm Manus Cranny. Danny Berger on location at the Private Equity Leaders Summit in Berlin. Welcome to Bloomberg Brief. Let's say your agenda. Apollo strikes an $11 billion joint venture deal with Intel. Co-president Scott Kleiman tells Bloomberg they're just getting started.
I think you're going to see more and more of this coming
from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Round two, Elliott management targets SoftBank a second time, pushing for a $15 billion buyback, according to the FT. And super return is in full swing. We'll hear from the top voices in private equity as Danny Berger sits down on the ground in Berlin. A very good morning. The tail that wagged the dog was the drop in yields, 15 basis points over 3 days, right the way across the spectrum of the curve. That invoked the bid to the S&P 500. You're barely 0.6% away from a record high. Two stocks to watch. Intel manages to sell off part of their joint venture in Ireland. Apollo will take a 49% stake, $11 billion. That is smart debt management. That is Pat Gelsinger really beginning to fine-tune the balance sheet over at Intel. Intel is bid by 1% this morning. Another breaking news story in the past 30 minutes. Dollar Tree, we understand from the Journal, is to spin off Family Dollar. They get 45% of their sales from Family Dollar, by the way, which is the out-of-town location store. And they had promised to close nearly 1,000 of those stores earlier in the year. So two stocks to watch. BMO say that the JOLTS data, the lowest in 3 years, really helps the case for a September cut. And oil is at a 4-month bouncing from a 4-month low. OPEC have not abandoned their active management program, according to RBC. And of course, Joe Biden gets a good boost. Oil had been down for 5 days in a row. We've just reversed it this morning. What does that mean for gas prices at the pump and elections? We know it's one of the most prescient issues for the voters on their mind. Prescient issue for me is that Danny Berger is on location, not vacation, at the Super Return Private Equity Conference in Berlin. My apologies to you. I think it was Freudian. I look at you in Europe, and I'm thinking of the southern beaches. But you're in Berlin. Good morning.
I'm in Berlin. Honestly, you might have said location, Manus, and I misheard you as vacation, so that one might be on me. It is busy here. It is loud, so it's a little bit hard to hear, but it is busy. And there is a sense, Manus, that the environment is coming back. You and I have had these conversations. Deal making is up. Buying is happening. The issue is that selling is not happening. So what is it going to take for this industry to finally unload some assets? Is it going to be painful when they do that? Will they have to take discounts? Manus, I'm really excited to have these conversations coming up. We're going to be speaking to Matt Swertnia. He is the head of PE at Ares. He has a lot to say on this and a lot to say on what he says are broken public markets that have changed the game for IPOs.
Yeah, but if you can't IPO, where do those assets get sold off to? And as you and I have discussed, at what discount? You've had the rain gods with your Apollo interview, so well done on that, and we'll see you in just a short moment with your Aries interview. That's Danny Berger on location in Berlin. So stocks holding up May's gain. We're kicking off June with moderately dovish Fed rate bets. RBC's Amy Wu-Silverman looks ahead to the summer. This is what she writes. Historically, June and July tend to be lower volatility months of the year. The market also tends to rally prior to US elections. This time, it could be different. Amy Wu-Silverman joins me now. Amy, good to see you this morning. I would say to you, you know, we've almost done a 180 from last week where we had this discussion maybe about a rate hike. We had higher for longer obsession. This week, we've now moved to earlier rate cuts in the year as the jolts and the PMI give us a little bit to chew on. Do you think not we're moving towards a Volmageddon, but sort of a vol moment, an increasing vol environment?
Hi, Manus. That's exactly right, because as you said, we keep swapping kind of predictive views on what's happening with rates, what's happening with a lot of things. And investors, frankly, they're getting this sentiment whiplash. And when you get the sentiment whiplash, you tend to get volatility start to bubble. Now, we've kind of had this pretty suppressed low vol, low VIX handle this whole year, but we're going into, you know, dare I say, a relatively unprecedented situation with U.S. elections, with one trial that's concluded for the Republican candidate, but another one that's on its way. So, you know, I don't think it's that unfair to say that this time, looking ahead, the U.S. elections could look different than history, along with many other things.
Now, you talk about the hump and volatility, and you very clearly say this. We do not have a hump for very long. We may have a moderate spike over the election, but of course, it's all the contingent decision tree analysis after the election that's perhaps not discounted. We're showing cross-asset volatility at the moment, but around that election, you think that my question would be, is volatility still relatively cheap after the election, and should I be looking at that as an opportunity?
I think it is relatively inexpensive, and I do think that's the kind of fat left tail that the market hasn't started to price in yet. Look, when I talk to investors, you know, they kind of look at elections and then they throw up their hands in the air and say, we don't really know how to price this, so let's just price this kind of the median in what happens during history, which is typically you get a rally into elections, you get that hump in VIX term structure for November, and then, you know, it's done and dusted. But the reality is we do have one precedent to look back to. That's the year 2000, where there was a contested election. And to me, you know, it maybe rhymes with history in the sense that we could get something that looks more like that than just your average run-of-the-mill election. If that is the case, volatility isn't pricing longer term, that just simply finding an outcome will take longer. And that's why I think that left tail hump is probably a little bit fatter than people are pricing in.
Yeah, we're just showing the SEP futures. I mean, they're obviously pricing higher than OC and DEC. Now, I love what you talked about. I mean, I started the show by saying we're 0.6% away from another record high. I mean, we over 23, 24, maybe 25 record highs is what we've had. And I like what you call the call exuberance. I mean, we've called up intermittently once a month. The call exuberance, that exceptional call buying was actually waning. And then, bam, Keith Gill and Roaring Kitty came back to life. Is that a seminal moment in vol?
You know, I think some investors would like to think that it isn't, but it really is. And I'll tell you why. Because the first time we had the meme frenzy, it really was something that people just didn't know what to expect the next day. To some degree, we have a little bit more of a playbook, right? We have seen this happen before. And I'll tell you, the one secondary effect that people have to really consider is as these stocks, like a GameStop, grow, they also become larger weights in different benchmarks. So like an XRT or an IWM. And the reason that matters is the last time around you had value investors, you had small mid-cap investors who became very concerned that they were going to start dragging their benchmark as this became larger proportions of the weight. And so you have this right tail risk again, this call exuberance that we're going to start to see because of the meme frenzy. So look, there are secondary impacts of this, even if you're not a long or short investor in GameStop itself.
is this where institutions and more sort of proprietary traders are bouncing? I mean, I know there's an entire entourage of retail that trade this, but then you have professional traders who actually trade this in their private books. And then you've got institutions, and this is where I really want to understand the impact on institutional risk-taking. What are people talking about as this meme frenzy reasserts itself?
Yeah, so the one thing, and I can tell you because these are kind of the incoming requests I'll get when you start seeing something like this meme frenzy reemerge, which is that call exuberance, which we also call skew inversion, when that call implied volatility outweighs the put implied volatility. People start to ask, okay, we see it here. Do we start to see it in other stocks? Because if you, again, we have a playbook now. If you look back to history, it doesn't tend to be just, siloed to this one stock. It tends to bubble to other names that people consider, I guess, part of the meme umbrella. And so, they ask, like, where else do you see call exuberance? Because maybe that's where we get other positive momentum begetting positive momentum. And again, it's very interesting because had this not happened, I would have actually told you that the right tail's been being sucked out of the market, actually. You hadn't seen it as sustained in AI names, for instance, but this is sort of like what I mean by sentiment whiplash. It just comes back the next day, and then people are kind of scrambling to rewrite their playbooks a little bit.
So let me take the other side of the bell curve then and go to the left-hand side of the tail risk, which must mean exuberance, call buying, meme stock frenzy to the left. Let's deal with the hedge. PIMCO are saying, look, modest bond losses, we both know that. The market is ignoring recession risk, JOLTS, PMI, services today, jobs tomorrow. The market is essentially ignoring the potential for slowdown, soft landing, quasi-hard landing, and they say bonds are a cheap hedge in that context. For you, how can I pick up cheap protection now?
Look, but protection, that left tail is incredibly inexpensive. I think the hesitation for investors is, burn me once, shame on me, but then, am I going to repeat it? The skew in the market, that downside protection just hasn't been working. That doesn't mean it won't work. We certainly have a slew of unknown unknowns, geopolitical risks, but, the post-COVID volatility regime has not been friendly for folks who have been hedging, and that's been really difficult. However, we do see S&P skews start to tick up. We are starting to see pockets of hedging, and we also have been seeing VIX call buying, which is sort of like thinking about a tail event occurring. Yeah. But it's just been difficult because those velocities have been very quick when there is downside, or you just haven't really seen that happen. And so especially as you go into the summer months, you have to take into account that seasonally you're actually getting lower volatility months that you're getting into.
Okay, Amy, great to have you with us, setting up the risk agenda. That's Amy Wu-Silverman there of RBC Capital Markets. Coming up, we're back to Berlin and Super Return. Ares head of private equity sits down with Danny Berger. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Let's get back to Berlin. Danny Berger's standing by with another top voice in the private equity world at Super Return. Danny.
Thank you so much, Manus. That's right. I am here with Matt Swartnia. He is the head of private equity at Ares. Matt, thank you so much for joining this morning.
Thanks, Danny. Happy to be here.
So the environment we're in right now, about $250 billion worth of deals announced for this industry so far this year, up about 23% compared to last year. It's from a low base. So where are we? How far away are we from normal right now?
So I think the deal market is going to continue to improve here in the back half. I do think it's been slow. I think 2022, 2023, and the first half of 24 has been slow as rates have come up and people have adjusted to that. But I think whether it's here at the conference or talking to limited partners, our customers, look, I think people want money back in the private equity business. Investors want money back. And I do think the drumbeat is getting louder for that. And with that, I think GPs, like ourselves, are going to be looking to sell assets. And I think deal flow will pick up here back half of 24 and into 25.
When that deal flow picks up, because we have seen some exits, but it's been the really high quality, the stuff that you can find a buyer for. So what does it look like when it picks up in the fourth quarter? Is this going to be painful for folks?
I do think what you referenced is right. I do think the high-quality companies, the companies that are growing nicely, I think they have lots of alternatives. I think it is that second tier of companies that isn't growing as well, and there's been price discovery about that. So I do think there needs to be a bit of a meeting in the middle between buyers and sellers on some of those second-tier companies. But we expect that to happen. Again, if the LPs are really asking us for cash back, I think that's across the portfolio, not just with your best companies. And so GPs have to look at what is the market price, for some of these companies. And I think that will help deal volume to pick up here in the back half that include that kind of second tier of companies.
Well, a lot of these companies were bought when rates were low, valuations were quite high. So that price discovery you're talking about, I really want to get into what that price discovery actually is. Are we talking about big discounts, slight discounts? What sort of things are we actually going to see in terms of price in this market?
Sure. I think that it really depends on the growth rate of the company. So a lot of people ask, hey, is the deal volume going to get much better when the Fed cuts rates or the ECB cuts rates like it may do here shortly? Well, I don't think it's really as rates driven as it is growth driven. So the question now is, if I'm trying to sell a company that's growing at 20% a year, I think that market and the opportunities for exit is wide open. If we're talking about a company that's growing 5% a year, I think that becomes more difficult, and I think you would have to take potentially a bigger discount than what you might have bought it at in 2021. So I think that's where a lot of private equity firms are focused, is really, can I grow my companies? Can I grow them faster than the industry rates? Because that's how I'm going to get the best price overall.
Right. Well, one exit option that is frozen over, iced over, choose whatever metaphor you want, is IPOs.
Yep.
But this is a stock market that is trading at record highs. I could easily conduct a thesis that says now would be a great time for IPOs. Look at what the public market is doing. It keeps going up and up and up. Yep. So what's going on?
So I do think there's been a big shift over an extended period of time of money from the public markets to the private markets. So there's a lot of that discussion that's here at the conference, whether that's private credit, whether that's private equity, et cetera. I think some of that has really been the smaller cap and the mid cap IPO space has really been taken over by private equity, broadly speaking. So now when we're a private equity firm and we focus in the middle market, when we're thinking about taking a middle market company public, we have to think about, can we take it public and can it have a relatively steady trading price and volume over an extended period of time, usually 2 or 3 or 4 years for a private equity firm to sell out of the company? Can it have that steady backdrop with which to sell shares? And what we see is a lot of volatility. So we see a lot of volatility in the market up and down. There are a lot of forces, there are a lot of money flows that I think have made that small and mid-cap public area more volatile than it was 10 or 15 years ago. And I do think then the public scrutiny for CEOs, for companies, I think it's made it more challenging to do IPOs.
I mean, the public scrutiny has always been there, though. So what's different this time?
There. I do think it's the volatility. I think it's the steadiness. So when CEOs and companies went public, there was a anticipation that I could grow my company and the stock price would stay relatively moderate and grow over time with the earnings of my company. Today, we're seeing stock prices go up and down fairly significantly, sometimes on no news.
A temporary phenomenon, do you think, or is this a broken market that is not coming back?
So I think it's a changed market for sure. Whether it's broken or not, I think it's changed. I do think this is one of the reasons why the private markets have become more attractive, especially in this middle market or the mid-cap range. I think companies, CEOs, even shareholders prefer that less volatility and staying out of the public eye for longer. And if you have a number of liquidity options that are not just going public, which I think private equity does, I think then you're going to see more people stay in the private markets and not lend themselves to that kind of scrutiny.
So this reminds me of a criticism that I'm sure you'll have a certain feeling about. I was with Cliff Asness a few weeks ago, who has this criticism of the private equity sector. He's a public equity guy, make of that what you will. But he calls what you do volatility laundering. This idea that your returns are outsized is just because you've masked over the volatility that is in public markets. And at the same time, basically what you have is just leveraged public equities. And that's the only difference. Tell me why he's wrong.
Right. So it's a great question. We get this a lot. So from my perspective, I actually believe the private markets are more consistent in terms of their valuations because the companies are being more consistent in their results overall. Right. I don't think there's as much volatility. In the public markets, I think there are a number of factors that can affect stock price that go beyond just the company performance. And we see that in terms of money flows, in terms of mutual funds, in terms of ETFs, and yes, in terms of meme stocks or other things that have played to the small cap universe.
Just quickly, Matt, on that, I mean, your conversations with CEOs, presumably there's been this desire to not have the volatility of public markets for a while, but what sort of tone are you hearing from them? Is it different when they talk to you about IPOing and maybe the fear of becoming a public company?
So for sure, I think as a CEO, what you're looking for is a fiduciary of your company, which includes not only your shareholders, but many employees, many other constituents that you're taking care of. And so when you're thinking about all of those and you head into the public markets, what you're trying to do is to not have this huge volatility in the stock price, which especially when it goes down, can cause some concern among your employee base, maybe among suppliers, among other people. I would rather stay in the private markets with the consistency of at least my valuation, my destination, and I can talk about how our company is doing and hopefully succeeding and adding value to everyone under that fiduciary banner, rather than having to deal with the latest news of whether my stock went up or down 20%.
Right.
So we for sure hear that.
Yeah, and you know that firsthand what that's like working for a public company, Matt.
We do.
We're going to have to leave it there. Thank you so much for joining us. It was really a pleasure speaking with you. That was Matt Swertnia, the Ares head of private equity. This is Bloomberg.
Danny.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's set up your trading day for you. The Bank of Canada rate decision hits the tape at 9:45 Eastern. U.S. services PMI will be closely watched after the manufacturing data yesterday, 9:45 a.m. and 10 a.m. More retail coming, Dollar Tree before the bell. Of course, we've got that journal story they're talking about selling Family Dollar. Lululemon will hit the tape after the close. She's on location. Let's see what the Apollo co-president had to tell Danny Berger.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
Danny, deep pockets there at Apollo, but I was fascinated by your Aries conversation, which is, you know, private for longer and avoid the vol.
Yeah. Yeah, I mean, look, it's been a thing for a while, right, that CEOs, as nice as it is to go public and maybe cash out a little bit, they're hesitant to do so because of the idea of quarterly to quarterly, but it's worse now, Manus, Aries said, because of the volatility in this market. So companies are going to be private for much longer.
Well done on the Apollo. You've got the news gods with you. We'll catch up with you tomorrow. More interviews to come from the team on the ground. Danny Berger on location in Berlin at Super Return. That's it for Bloomberg Brief. And the team, surveillance is up ahead. Context matters on Bloomberg. From New York, good morning.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up the, we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
There is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way.
For markets anyways, you know, I think probably the next few months are going to be very choppy.
The market always moves ahead of the Fed.
The market dynamics and the market structure actually afford the ability to hedge really almost like never before.
We're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance begins right now. Equity futures on the S&P 500 positive by 0.2%. Monday looked a lot like Tuesday, squeezing out a day of gains right at the end of the session. In the bond market, pretty consistent. A rally, 4 consecutive days of yields dropping, down about 20 basis points at the front end on a 2-year. Over that period, down about 30 on a 10-year. We are 2 for 2 this week. ISM manufacturing, weaker than expected. JOLTS, job openings, lower than expected. A massive focus, a lot of weight being put on the ISM. A little bit later on this morning, Bramo, that's the one to watch.
You're asking a good question, which is 2 for 2. Is bad economic news going to be negative for equities? The answer is we don't know. And really, one thing that Jim Reed over at Deutsche Bank pointed out is even though you do have some of these wobbles on an entirety basis since we got back to trade after Memorial Day, the stocks are only down about 0.25%. So it's not as though it's been a massive drawdown in response to some of the negative news.
But you can feel that tension. It's like that tug of war. You're going nowhere, but there's tons of tension in that rope right now. I think a great example of that is job openings yesterday. So let's look at the ratio of openings to unemployed people. That's east to 1.2. We know where that was at the peak of all of this. The ratio was 2 to 1. It was 2 to 1. It's come all the way back down to 1.2, the lowest since June 2021, and really, really close to where we were in 2019. So we've got to ask the following. Are we normalizing, or are we going to a deep, dark place that we don't want to go to?
Which is part of what some people are saying with Andrew Hollenhorst calling for more rapid deceleration in some of the jobs growth. There's another potential option here, too. If we're going back to trend growth, are we pricing that in accurately? How do we price that with some of the mega trends that Wei Li was talking about, sort of overlaid on top of it? Struggling with that is also sort of giving people a sense of, okay, what do valuations look like after some of the run-up we've seen so far this year and last?
More data coming up later. The ADP report, one to watch. And, of course, the ISM services before that. You'll get a PMI too. And then Friday. It's the big one, isn't it? Payrolls Friday. The number looks like this. A sneak peek, 185, the previous number, 175. And a lot of strategists trying to work out what bad news actually is this coming Friday.
Although, is it going to be in the headline number, or is it going to be in the revisions? An increasing focus on revisions, not just to the previous month, but also to what we're going to get this week, which is revisions to 2023 numbers. This has been something that has been giving people a sense of insecurity around the data. Mohamed El-Arian talking about this. We're data dependent on data that gets shifted around in the post facto. And so, yes, we're going to be focusing on what is bad news, but how do we understand the trends after we get some of the revisions that maybe reset some of the expectations akin to what we've seen over the past few years.
Would you like to talk about some volatility? Let's do that. Let's head over to India and talk about the Nifty 50, the benchmark equity market index over there. Today, biggest one-day rally since 2021. Okay, yesterday, biggest one-day drop in about 4 years. We've been all over the place, and I think right now we're basically back to where we were on Friday, and we're still trying to work out what the future of things look like in that country politically.
So we're trying to figure out what the actual policy implications are. It highlights how, if we're concerned about the polling in our country, in the United States, polling in India after the election was incredibly inaccurate because it seemed to suggest a much bigger win for Narendra Modi. How he gets this coalition of allies in a way that he hasn't had to for years is going to really be important for policy. On a broader sense, though, it raises this question about political volatility in a broader scheme, not just in developed markets, not just in the United States, but globally.
Massive focus, lots of interest in that story. I can tell you in about 25 minutes from now, we'll catch up with the team on the ground in New Delhi. Looking forward to doing that. The scores this morning, a good morning and welcome to the program. Your scores look like this. Equity futures on the S&P 500 positive by 0.2%. Yields a little bit higher after dropping for 4 straight days on a 10-year, 433.96. And we get closer and closer to that ECB rate decision / ECB rate cut. 108.71 on euro dollar. We're negative by about 0.1%. The lineup for this hour looks a little something like this. Emily Rowland of John Hancock, passing on the bad news is good news narrative. We'll speak to Ed Al-Husseini of Columbia Threadneedle as India's Modi clings to power, and Stephanie Roth of Wolf Research expecting another slowdown in US jobs. We'll begin with our top story. Bond yields declining for 4 straight days coming into Wednesday, following another downside surprise on economic data. Emily Rowland of John Hancock Investment Management writing this. We are not chasing the bad news is good news narrative. Eventually, bad news will just be bad news. Emily joins us now for more. Emily, how close are we to that point? Are we at that point right now?
Well, to your point, John, it's just been a couple of days here, but there's been some pretty notable cross-asset trends. We look at things like small cap equities. Yesterday, they were down over 1%, even with that decline in yields. Over the past month, we've seen the 10-year Treasury yield decline from 4.70 to 4.35, and small caps have not kept up with their large cap counterparts. Of course, the narrative that's been permeating the markets is small caps should be the biggest beneficiary of rates coming down because they have higher interest burdens, and as the cost of capital comes down, that'll be a positive for those small cap stocks that tend to be less profitable. We're just not seeing that play out. We're seeing cyclical stocks get hurt. So we're feeling kind of sniffs of the market reacting to, hey, maybe this isn't so great, and that the Fed pivoting is actually maybe not going to be for the best reason.
We're in new territory, and I need your help navigating it, Emily. I'm trying to work out the distinction between a welcome cooling in the data and an unwelcome deterioration. What does that look like come Friday?
Yeah, it's really tough, and I think it's right to be watching the labor market because we've seen some cracks forming. You mentioned the JOLTS job openings data this week falling to the lowest level since 2021. The labor market continues to normalize. The whisper numbers lower than that 180,000 consensus view on job gains this month. I think we could see jobs kind of join the string of weaker than expected data. We've had retail sales. Look at the Atlanta Fed GDP Now estimate. It was over 4% pretty recently for Q2, and now we're at 1.8%. So we're seeing a notable deceleration in the data. Now, if you look overseas, those economies are actually looking a little bit better than expected. So the U.S. may sort of draft off of better growth in areas like Europe. China PMIs overnight showed some strengthening. But we're going to have to see kind of when that point is. And I think looking at things like initial claims are going to give us a sense.
How do you understand the Fed's policy and sort of their response function at a time where you really codified a pivot party and you talked about how it was fueling a lot of the gains in markets? Maybe the Fed wasn't wrong to pivot. Maybe they're going to cut rates in July. This is the assumption of the likes of Andrew Hollenhorst and Steve Englander. Do you think that looks increasingly appropriate, that maybe they were onto something about a weakening in the economy?
Yeah, Lisa, we think they were onto something, but the party just started way too early. I don't know if you remember kegs and eggs back in our sorority days. Maybe you guys recall that. But, back in October, the Fed hinted at 3 cuts, and then I just thought of that.
That's great.
And then, the bond market extrapolated that to price in 6 cuts. So the party started a little bit early. And I think the challenge with that was that you had this massive loosening in financial conditions, you saw risk-taking take hold, and the better economic growth was a good thing, but it comes with a nasty side effect of higher inflation. And I think you saw that in the form of the resilience across the housing market, especially in the first quarter. So the Fed's got a challenge on their hands. Yes, inflation's coming down, but it's taking a lot longer than expected thanks to the Fed's own sort of rhetoric back in the fall. So the Fed's sort of backed in a corner here. I think wage growth on Friday is going to give us some more clues on the inflationary backdrop, but it's probably going to be a little while here until we can see those cuts.
You're raising an interesting point about some of the optimism that was baked in that needs to come out. Where does it need to come out in particular in markets where you're looking at quality stocks, you're trying to stay away from cyclicals, and we're defining what does quality mean at a time where NVIDIA to the moon trades like a meme stock and yet seems to be the biggest winner always?
Yeah, you've got to focus on the earnings, Lisa, in our opinion, and we would be looking to trim areas that are not profitable. We talked about small caps already. We would be fading that and continuing to lean into quality. We want to own companies with great balance sheets, lots of cash, but we also want to think about owning them at a reasonable price. You mentioned technology companies. Yes, the valuations are looking somewhat extreme. No late 1990s, but they're looking overbought, but the earnings are there. You look at NVIDIA, yes, the stock's up a lot, but the earnings are up over 400% year over year. So you've got to find those quality companies. We're finding it mostly in U.S. mega cap tech, communication services. We'd even be sprinkling in a little bit of utilities now to balance out that tech exposure.
We'll speak to Lisanne Saunders a little bit later, Lisa, of Charles Schwab. NVIDIA's correlation to the market was 0.95. It's now 0.3.
Oh, yeah.
What a change.
I mean, essentially, NVIDIA is no longer the market in the same kind of way. It's interesting. Emily was talking about 1999. Washington Crossing advisors, Chad Morganlander and Kevin Karen, came out and said, in both 1999 and today, the stock market exhibits strong momentum and herd mentality, particularly among, that's right, the largest, most valuable companies. So some people are drawing the analogy with 1999 in a more aggressive way.
What do you make, Emily, of that breakdown of the correlation between NVIDIA and the broader market?
Yeah, we think it's healthy. Again, you're seeing a bit of a broadening out here. Some more breadth is certainly a good thing. It was time for those names to maybe take a little bit of a breather in terms of their dominance. It's still there. And again, it's a key reason for our emphasis on U.S. versus international equities, just that the fact that we have a massive exposure to tech here. That's where we're finding the most quality. But we would also be looking at areas like mid-cap stocks. If you look at the S&P 400 index, it's actually trading at the steepest discount to its large cap counterparts since the late 1990s right now. So we think that there's a nice opportunity to lean into mid-cap stocks, take advantage of that valuation discount, and also get exposure to areas like industrials, which are benefiting from onshoring and industrial production that's picking up in the United States.
Emily, help me out here. So basically, we start the conversation by talking about bad news is bad news and end it by saying lean into mid-caps. Can you make that work for us?
Yeah, so we're balancing that out, John. You know that we've also had an overweight to high-quality bonds here. We love the fact that bonds are giving you income, 5-6% income. Even if you've got to wait a little bit for the duration tailwind to kick in, you're still collecting income in an environment where we do think economic contraction's coming. It's hard to see it right now, so we want to maintain exposure to areas that are benefiting from fiscal spending that's going on. We're finding that in mid-cap equities. We want to have some offense in the portfolio, but we're balancing that out by collecting 5-6% income here in high-quality bonds. We like that trade, too.
Just before you go, can you tell us how important you think that ISM services number is a little bit later this morning, particularly given what we saw on Monday?
Yeah, I think it's very important. Markets are very sensitive to that right now. Retail sales disappointed. We are seeing cracks in the consumer. So we're going to need to see, how that side of the economy holds in here in a time where a lot of people are pushing back on higher prices.
Emily, thank you. Emily Roden there of John Hancock Investment Management. On the labour market, you mentioned Andrew Hollenhorst a few times this morning. Let's talk about the man from Citi. As the labour market moves from excess demand, too tight, to excess supply, too loose, there will be a period of seemingly normal balance. Is that where we are right now? We think this is where the labour market is now, and further weakening, including job losses, is likely in the coming months. This is quite amazing stuff coming out of Citi. Citi is sticking with it. July rate cut. We're going to see that weakness in the labour market over the next 2 months.
And other people are joining him right now because there has been this consistency to the negative revisions, to the downward shift. You talk about JOLTS, the ratio of job openings to unemployed individuals. 1.2 is basically pre-pandemic. And this goes to exactly Andrew Hollenhurst's point. This is a point in time that looks normal, but it is on a line that is moving. And that, I think, is what a lot of people are hooking into.
Is it normal, or are we going to a darker place? Bramo will discuss through the whole of this week. Tomorrow, look out for this. Veronica Clark from Citi joining us on the programme at 8:30 Eastern Time tomorrow morning. A conversation you don't want to miss. Equity futures right now on the S&P just about positive by 0.25%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Hewlett-Packard Enterprises surging in the pre-market. The company reported revenue that beat estimates and raised its outlook for the year. Increased demand for its servers and more availability of NVIDIA's chips led to a jump in its sales of AI systems. Hewlett-Packard has seen only modest gains this year, while its competitors Dell and Supermicro experienced big jumps in their share prices due to their booming AI server businesses. And Intel and Apollo are teaming up. The chip maker announcing that the private equity firm is acquiring a 49% equity interest in a joint venture related to Intel's Fab 34 for $11 billion. Apollo's co-president spoke to Bloomberg's Danny Berger at the Super Return Conference in Berlin.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
And celebrities and well-known brands were the target of a TikTok hack. The hackers sent a malicious link through private messages to hijack prominent accounts, including CNN. TikTok said it's taking steps to mitigate the incident and prevent it from happening again. TikTok's future in the U.S. is uncertain as its Chinese parent company ByteDance currently faces a deadline to sell the app or face a ban. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the programme, oil markets under pressure.
We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the U.S.
We've had quite a slide over the last week. That conversation is just around the corner, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures doing okay, positive here by 0.24% on the S&P 500. Got this message just moments ago. Sure seems like your guests are tilting very cautious, not just Emily Rowland. Need some Jake Pulosky to cheer me up.
well, Jay Pulosky used to have company in Neil Dutta, but no longer. So your one stalwart is Jay Pulosky, who can come on and say buy everything. And Jay, if you're listening, call in, give us some optimism.
Jay's on like a bullish island right now. In the bond market, yields a little bit higher by a basis point, 433.96 on a US 10-year. Under surveillance this morning, oil markets under pressure.
Roughly 70% of global oil demand depends on the services sector and the consumer, as opposed to the goods sector and the industrial sector. We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the US.
So here's the latest. Oil holding near 4-month lows, a surprise in US inventory data boosting supply concerns. The American Petroleum Institute reporting a rise in US crude stockpiles and gasoline inventories. Nadia Martin-Wigan of Swelling Capital joins us now for more. Nadia, always great to get your perspective on these things. Lisa and I were talking about it yesterday. Is it demand? Is it supply? Is it a combination of both?
In our view, it's Swelling Capital. The market's really focusing on the demand side of the issue. What OPEC communicated is that they will extend the cuts through Q3, but then they would like to bring back some oil in an orderly fashion in Q4 if demand merits it. Instead, the focus of the market has been on the fact that, oh, they're going to bring back oil, they're under pressure within the group, and therefore we might have an oversupply. And that's Swelling Capital. That's really not how we view the communication. And when you look at these surprises on the supply side, we haven't been surprised. You know, we had big winter outages in the US in January, and oil production came back in the US in February and March. So it's not really a surprise on that side, but the concern has been whether OPEC would be okay with this rising market share and if members would throw in the towel and leave like Angola did last year. The communication from this weekend from OPEC suggests the group is intact. They are discussing things openly, and if and when production comes back, it will be in an orderly fashion.
Can we just talk about demand a little bit more then? What are your baseline expectations for the next several quarters?
So we expect that demand will actually rise in the third quarter. We're not at a 2.2 million barrel per day increase expectation the way OPEC is, but neither are we as low as 1 million barrels per day. We probably see around for the year 1.6, 1.7 million barrels per day year-on-year demand growth. And in Q3, we should see that pop locally coming. The problem is that refinery margins have become much, much weaker, and coming out of maintenance season in China now, we're not seeing an expectation of a run boost, and we've actually seen run cuts. And this is where we need that first line of demand to come to the forefront and take up some of the overhang we've seen in the crude supply market in the last several weeks.
It's a bit too confusing for me to focus on the entire world and all of the demand just in one lump. So I want to break it down. You mentioned gasoline stockpiles, and John was talking about the build that we saw over the past week, jumping by 4 million barrels. How do you place that into the context of the increase in driving and the increase in travel that you just talked about? Is that really just because there were some power outages over the winter?
Part of it can be that. It's also a concern, you know, what were the refinery run rates that produced that gasoline in the first place, right? As your kind of implied source of demand. And part of the concern has been that the refinery run rates have been quite low in the US since maintenance season. And that started to change last week. So the next set of data that we received this week on the EIA will be a very important telling sign if we really do have that demand, or if the economy is feeling pressure on a personal level. When we look last year, we had a lot of short covering in gasoline going into Memorial Day weekend. We're going to have that data result, this week now. And then the market was not convinced that demand was there and continued to short on the gasoline side basically until July or into the start of July. And that is where we're at this tipping point on, do we think there is actually healthy demand in the US for this summer right now?
Nadia, a number of people come on this show and say that they're bullish on energy, they're bullish on oil stocks in particular, in part because of the whole AI trend, that this is going to somehow increase demand in the very near term. We are seeing adoption in a number of places. Do you buy that? Do you have to calculate that at all into the demand forecasts, or is it all more traditional types of travel and domestic demand that typically has really fed into the supply-demand dynamic?
Right now, on the actual oil side, oil is still an expensive source of energy. So that incremental additional demand shouldn't come from oil immediately on the forefront. On the other hand, when we look at things that the Biden administration has done, we've actually had 100 factories built in the U.S. Those are building demand, and that's not just in terms of AI. In terms of the administration, on the marginal side, yes, if you're looking at that last source of demand, then oil does really matter. But still, relatively speaking, we should be looking at renewables. We should be looking at natural gas. We should be looking at coal costs first.
Let's talk about the cyclical signal, which essentially is what Lisa's getting at. What kind of signal can we take away from crude as a cyclical signal? I think in the same way about copper now as well. We used to refer to copper as Dr. Copper. I'm trying to work out if it still has a PhD in economics or whether it's a climate scientist now. Nadia, what is it?
Well, on the copper side, absolutely. That long-term story, very much intact, and that is being promoted by the AI picture, and that is where in the medium term, it can also have an impact on this overall oil cycle. But it's an even more important natural gas story and LNG story in that medium term, because we're dealing with grid power that will help it, not just backup generators based on diesel. So I think it's an even bigger story for natural gas and grid investments. And what do you need to build grids? You need copper, right? So it is an argument in that regard. And then finally, a little bit on the oil side.
Nadia, appreciate your input. Brent crude bouncing back. We're positive by about 1/3% on Brent. On WTI, up a quarter, 73.42 this morning on WTI crude. The move in crude sort of reinforcing the general mood off the back of the economic data over the last couple of days, right?
I think that that's a good way to characterize it, because right now, even as Nadia said in her notes, that it didn't really seem to justify the kind of reaction that we got from the OPEC Plus announcement, considering that they're keeping in place a lot of the production cuts through October. Yes, people are focusing on the other, the bringing things back online in order to confirm what we're currently seeing.
You wake up, you're looking for the risk of a slowdown, you search the screen for something red. Crude shining brightly for a few days.
You watching me?
You're like, economic slowdown. No, I think that's what a lot of people do. Coming up on the programme, we'll take a look at Indian equities bouncing back as India's Modi clings to power. That conversation just around the corner, live from New York City. This is Bloomberg.
news that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Three days of gains on the S&P 500, including very small days of gains. Monday, Tuesday, right at the end of the session as well. Very similar sessions. Check out this morning's. We're positive by 0.2% on the S&P. On the NASDAQ, up by about 0.4%. On the Russell, up by about 0.15%. I have to say, Bramo, I think the equity market's kind of dazed and confused, doesn't know what to do with this economic data. The bond market is very, very set on what to do with this economic data. That's buy it. Rally. Yields lower. Yields look like this: 2-year, 10-year, 30-year. Retracing some of the move lower we've seen over the last few days. We're higher this morning by a basis point or two on a 2-year and a 10-year. Though, Lisa, we've seen a double-digit basis point move lower over the last 4 days.
Yeah, you mentioned almost a 30 basis point move in just 4 sessions for the 10-year yields lower. That is the biggest going back to mid-December. There is conviction that, yes, we are going to be starting the rate cutting cycle. We're building in a greater expectation of the number of cuts. But also it seems like people are resetting longer term expectations in terms of longer term base rates as well. I mean, it's entire shifts as people sort of get this sort of starting gun to go by duration even.
It just feels like the bond market's at the mercy of the next economic data point. There's several of them. A little bit later, we'll talk about them in just a moment. I just want to turn the page to foreign exchange. The euro shaping up as follows, going into the ECB tomorrow. Slightly negative by 0.1% at 108.66. If I'm on that governing council right now, this is a fight about July. It is not a fight about June. That is done and dusted, over with over the last several months. What does the next quarter look like for the central bank?
And how much do they really draw a parallel between the inflation that they're seeing in the euro region with what we're seeing in the United States? There's a real question, especially with hotter than expected data. That said, some cold water on that this morning with German employment coming in light. So you look at this scenario, how do they sort of look at, yes, inflation that's stubborn, but growth that's clearly decelerating? And frankly, it is the same issue that the U.S.'s Federal Reserve is going to be dealing with.
Germany seems to do what Germany keeps doing. That economic data is not great at all.
Exactly. At a time.
Kind of been the theme for a while, right?
Yeah, which raises this question, who's going to be the hawk and who's going to be the dove? And we've been talking about this in terms of usually Germany being the one to have restriction, et cetera. You know, are they going to be sort of arguing, look, we need a little bit of help? It's sort of a really interesting question at a time where the ECB doesn't have the luxury of acting as one economy in the same kind of way that the United States ostensibly does, even though a lot of people are saying it isn't really when you look under the hood.
How divided is that governing council going to be in the next 24 hours? Under surveillance this morning, a downside surprise to JOLTS data. US job openings hitting their lowest level since 2021. Another look at employment later this morning at 8:15 Eastern time. We'll get the ADP numbers. Plus, I think the big one for most of you out there, ISM services, Lisa, 10 a.m. Eastern.
I thought you were going to say the Bank of Canada decision. No, I'm kidding. ISM services, to me, really will be potentially the 1-2 punch of this week in terms of ISM manufacturing coming out. And then if services come in weak, do people come around to the idea that, yeah, we are decelerating, and now it's just a question of what is normalization versus true weakness? I just wonder, though, what this does to stocks. And you started out saying it's bad news, bad news. It's bad news for the Russell 2000. Everything's bad news for them right now, pretty much, either way. But what about some of the big tech names? Are they sort of insulated in this way, or are we looking at sort of a 1999 moment that Julian Emmanuel was talking about, given the fact that we've seen this incredible run-up?
Well, before we get to the equity debate, let's just sit on The Economist. I don't think you settled that debate in any way, shape or form this week. We'll have the same conversation. Take yesterday, for example. You and I have talked about this a few times already this morning. Quits rate, held at the lowest level since 2020. Ratio of openings to unemployed people, talked about this a few times, 1.2, lowest since June 21, down from the peak of 2 to 1 and very, very close to the pre-pandemic norm. So you're going to have some people that say we're just normalizing, other people that say, yeah, that's what it looks like right now. We're going somewhere darker.
That's the reason why I think revisions are going to matter a lot. Remember back in 2022, when we got those revisions for that year, it totally shifted the narrative about how much resilience there was in the economy and how much inflationary pressures were building up and how much the employment market was tightening. Do we get a similar kind of move in reverse if we get, say, revisions that show a real decrease of jobs in 2023? That's the kind of thing that could actually settle that debate in a more material way, at least in terms of market action.
Much more on that debate throughout this week, particularly around payrolls this Friday. Let's turn to this story. President Biden in France, ahead of a state visit with President Emmanuel Macron. The president is said to mark the 80th anniversary of D-Day. Later this week, he'll meet with Ukrainian President Volodymyr Zelensky and deliver remarks on democracy and freedom before next week, the big G7. And I have to say, one thing that was talked about maybe a month, 2 months ago, and hasn't been talked about at all really over the last couple of weeks, what happens to Russian assets in European financial institutions? I'm thinking Belgium, I'm thinking France. What happens to them going into next week?
The Financial Times actually put out a piece saying that the rumor is that the U.S. is working with its allies in Europe to come up with some sort of loan backed by these assets that will then allow them to basically monetize those assets, the loan being indefinite and possibly something that can be relieved at some point. It really does seem like this is getting increasingly pressing as the political imperative decreases, at least among a population in the places like the U.S. and in Europe. So that, to me, is going to be a real question with some of these meetings, especially with the idea of Macron and Zelensky sort of paired together.
What is the loan? Against future income streams or something like that? Is that what it is?
It's something like that, where they can get away with it, basically saying if we have it for 50 years, we have an income stream of a certain amount, we can basically imply we can give you guys as much money as we want.
Watch this space. You're going to hear a lot about this in the next week or so. Let's turn to India. Lots of attention on this story. Narendra Modi vowing to continue as Prime Minister for a third term. Modi and his BJP party losing seats in Parliament despite exit polls, which fueled expectations for a super majority. The Prime Minister will now have to rely on a coalition for the first time. I'm pleased to say that we can catch up with Bloomberg's Menaka Doshi joining us from New Delhi. Menaka, can you give us the current state of play? What is going on and what's changing on the ground?
Well, good afternoon from New Delhi. The shock has worn off of that very weak mandate that Narendra Modi won. The outcome, as you described, coming as a very big surprise to investors. We've seen some recovery in India's stock markets, which sold off yesterday and have recouped some of those losses through the course of today. I think investors are coming to terms with the verdict and maybe even hoping that this could likely be a stable coalition because both the key alliance partners of the BJP, which is Modi's partner, have reiterated their loyalty to this coalition through the course of today. So they're expecting a stable government and policies similar to the policies of previous Modi governments. In short, that is fiscal discipline, continuing incremental reform measures, though of course the lack of a supermajority, as you call it, will curb this Modi government from any large reform processes. Now, that's how the markets have fared today. The rest of the investors from across the world, whether it's an Apple or a Samsung, will be watching to see how Narendra Modi addresses some key weaknesses in the Indian economy, which have contributed to this weak election verdict. For instance, very weak rural consumption and no pickup in private investment. We'll get to know more once the government is sworn in. We expect that to happen this weekend. That's what media reports locally are suggesting. And then we'll have cabinet formation coalition. We'll know who the key economic ministers are, what accommodations have been made for these allies in this coalition government, and eventually the Indian budget will give us the best clue on what kind of economic policy Modi 3.0 will follow. Will it be close to the previous 2 terms, or will it be a fresh start altogether?
We're all following your coverage, and we appreciate it. Bloomberg's Manika Doshi there on the ground in India's capital, breaking down the surprise election results and a surprise move in this equity market as well. A big move. Big pop today, biggest one since 21, big drop yesterday, biggest drop since 2020.
And this goes to this question of expectations and the idea that the exit poll initially gave him the majority that people expected. So you saw that massive rally, and then it all was taken away yesterday. So this is about expectations as much as it is about economic policies that really are a black box.
Let's continue the conversation. Ed Al-Husseini of Columbia Threadneedle joins us now with some experience of EM sovereign debt ratings. Ed, let's get straight to it. Your notes. If you are a global supply chain manager at a company like Apple, waking up to the news you woke up to yesterday, looking at these results this morning, what are you thinking?
Yeah, you've got to be a little bit more nervous. The whole story in India going forward is leveraged to the infrastructure investment. India is catching up to East Asia. India is becoming more competitive vis-a-vis China, but that's going to take a lot of infrastructure investment, and a lot of these big ticket projects may now be on hold given this coalition construction.
You pointed something out, Ed, drawing a parallel between this election with Mexico, saying that there is a takeaway, which is investor nervousness about eroding governance. Can you give us a sense of what that means at a time where a growing number of people have come on this show saying emerging markets are going to benefit from some of the investment in some of the new technologies and looking to diversify away from China?
Yeah, that's right. I mean, fundamentally, the bedrock of policy is governance. It's predictability. It's the extent to which we can build institutions to facilitate that investment, particularly private sector investment. And in a lot of these emerging market economies, I mean, if you look at the last 20 years or so, investment and productivity have underwhelmed. India is a fantastic case in point where it grows 6, 7, 8% a year and yet is unable to generate jobs. It's unable to distribute that growth effectively. And unless you have those institutions in place, the forward-looking productivity story gets that much weaker. And on that front, across the EM world, the elections over the course of the past couple of weeks have been a little bit of a setback.
Is there an investment thesis that's longer term, more than the knee-jerk reactions that we've seen so far in Indian stock markets? Is there something that you're taking away, that you're shifting a little bit around the edges, your allocations?
Yeah, I mean, I'll speak to the corporate bond markets a little bit, which is where we have most of our exposures. India disproportionately, and I think in contrast to many major emerging markets, disproportionately borrows in local currency. So they're not as dependent on foreign investors as many of the other larger EMs. But however, in the dollar bond market, most of the issuers are again geared and leveraged towards the infrastructure story. Adani is a fantastic example of that. Port infrastructure, energy infrastructure. So far the reaction there has been very muted, particularly relative to the equity market. But looking ahead, I think your previous speaker noted the budget that's coming up. Those budget priorities are going to be very important in shaping our exposure.
Ed, can we just build on some of the outcomes, not just India, but also Mexico, as you both mentioned just a minute ago? In Mexico, we got a big majority and people are unhappy. In India, we don't get a big majority and people are unhappy. And I think for those of us that spend a lot of time in DM and not enough time in EM, tourists, not like yourself, we're trying to work out what do we actually want from these governments? What is it about India specifically when it comes to coalitions that is so negative for markets?
Let me come back to the story of institutions. I think in both Mexico and India, the narrative is this. If you have a government that's too powerful, and in Mexico is a case in point, it can erode the institutions that undergird that government. They're at the moment talking about potential constitutional reforms. They're talking about Supreme Court reforms. In India, at the same time, when you have a government that's leaning populist, the fact that they now have to form a coalition means they're going to be taking their eye off the ball on the economic issues and potentially pivoting more towards domestic, more nationalist issues. And this is a distraction really from a very significant challenge that India has over the coming decades. Again, lifting productivity, creating a job market that is much more efficient and effective. This is somewhere where India has lagged significantly. And so as investors, you sit back and you say, look, the through line here is institutional quality matters. In EMs, ultimately, we're underwriting the quality of policymaking. And these election outcomes make us take a little bit of a step back and reassess.
And I tell you, I think for a lot of people waking up this morning, listening to this conversation, they're not thinking about Mexico City. They're not thinking about New Delhi. They're not thinking about what's happening in South Africa. And you know where I'm going? They're thinking November in America, in Washington, D.C. Is there any read across here at all for you, Ed, for you and the team?
Look, I think trade policy is on the ballot in the U.S. There's been an important shift in U.S. trade policy over the course of the past several administrations that's been impacting EM. The relationship with China, particularly the economic relationship with China, is reshaping the opportunity set for emerging markets. And again, India and Mexico are at the center of that conversation. So yeah, I think the outcome of the election from an economic perspective will matter quite significantly, particularly for trade-exposed emerging markets. There's a good number of emerging markets that are relatively isolated. They're commodity traders. That's a separate story. But if you're part of the global manufacturing value chain, India is trying to move up in that space. Mexico, by virtue of being proximate to the U.S., is a very important part of that piece. For those economies, this is going to be a critical election. And I'll set aside the issues around what the Fed will do after the U.S. election as well, which will be critical for EM.
We'll save that for another day. Ed, thank you, sir. Ed Al-Husseini there of Columbia Threadneedle, breaking it down for you. I was thinking more along the lines of erosion of governance, degradation of institutions, institutional resilience come November and beyond.
That is the one line that I've highlighted from Ed Al-Husseini. The idea investor nervousness about eroding governance is something that we hear a lot in the United States. Is that being priced in? What is the price for that?
How do you do that?
And this is something that people are grappling with at a time where it's sort of interesting. There's some people who don't mention it at all in their outlooks. And then you've got PIMCO's sort of 3 to 5 year outlook that had that as their first point, sort of underpinning why yields are structurally higher. To me, this is just sort of, again, it's sort of a mystery depending on people's view of, the future and just how significantly those governance aspects will be eroded.
Ray Dalio gave a nod to it, I think, a subtle nod to it overnight at the Greenwich Economic Forum. Look for those comments a little bit later. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. British Prime Minister Rishi Sunak and opposition Labour Party leader Keir Starmer sparred over taxes, the cost of living, and the country's health system in a televised debate ahead of a July 4th election. A YouGov poll of viewers found that Sunak just barely came out on top by 51% to 49%. Both contenders said they would maintain Britain's close ties with the United States if Donald Trump wins in November. The New York Stock Exchange and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. He says his exchange will try to entice companies seeking relief from increasing compliance costs at the NYSE and NASDAQ. And Elon Musk confirming he diverted artificial intelligence chips away from Tesla and to his X and XAI ventures. CNBC had reported that the billionaire redirected 12,000 of the NVIDIA GPUs originally slated for Tesla to X. In a series of posts on X, Musk wrote that Tesla had no place to put NVIDIA chips where they could be used, saying they would have just sat in a warehouse. Musk had posted back in April that Tesla was planning to spend around $10 billion on AI this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the labour market looking for balance.
I think the hard labor market data is really what is important to us. The soft data has been telling us that the economy stinks for quite a while now, and it's the hard data that is actually going to move the needle.
A story up next. You're watching Bloomberg Surveillance.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equities a little bit firmer, positive by 0.2% on the S&P. Under surveillance this morning, the labour market looking for balance.
I think the hard labor market data is really what is important to us, because when we look at the Fed's reaction function, we think it's becoming more asymmetric, meaning that the Fed is going to be more sensitive to weaker economic data than they are to continued strength. The soft data has been telling us that the economy stinks for quite a while now, and it's the hard data that is actually going to move the needle.
So here's the latest. Job openings falling to the lowest level in over 3 years, with more labour data ahead of payrolls on Friday. Stephanie Roth of Wolf Research expecting, quote, another month of continued moderation in the labour market, albeit firm. We're looking for a below consensus payrolls print of 165, the consensus 185. Stephanie with us around a table in New York. Stephanie, good morning to you.
Good morning.
The difference between just normalisation and going to somewhere sort of sinister, dark and scary, what is the difference?
The difference is layoffs, and we're not really seeing any signs of that. So, I mean, if you look at historically, a payroll print of 165 has been the average over the past decade, and that's a really solid number. The concern is that we're all of a sudden going to sort of spiral into something that's more significant. But
we go
there's no
beyond
sign of
that. Why wouldn't you be concerned by that? Do you not
Because
see
profit
that in the
margins are fine.
ISM manufacturing disappointing? None of that stuff entertain you?
The measures of sentiment haven't been a great measure of the economy over the past year. If you look at consumer confidence, that would have told you we were in an outright recession for all of last year when consumer spending was fine. So, yeah, I mean, of course, you're starting to see a moderation, and these measures of sentiment measure month-over-month changes. And sure, you're seeing a moderation, but that's what you would be expecting for payrolls to go from an average of 250 to something in the 100s.
In the revisions, when you look back at the JOLTS in particular, you can see that basically it's been flatlining for the past 3 years in terms of job openings, really a downward shift that we've seen pretty consistently. Based on some of the revisions that have been coming in lower, could that shift your view about how sanguine things truly are right now?
I mean, if you rewind back to last year, we were talking about job openings being too high, and that was a problem, and that hurt the Fed. And now we're talking about the exact opposite, with job openings coming back down towards normal. So that's kind of a good thing. We want the labor market to normalize. Of course, everyone's going to start extrapolating on the trend and worry about that. But it all comes down to profit margins. And so far, margins are generally pretty good. And companies are unlikely to do layoffs unless their margins are really starting to get squeezed and they're forced to.
Well, they're good on the sort of averages, but when you dig under the hood, they're real winners and losers here, and you see that pretty consistently across the board. Smaller companies are the ones that typically employ more people, right? And they're the ones that have been hurting more. How quickly could this turn come? This is what Andrew Hollenhorst has been talking about.
I mean, and it could happen quickly, but the good thing is for the Fed, they have the liberty of being able to cut. Last year, inflation was way too high. If you started to see the cracks in the labor market, there was nothing the Fed could do. But this time, the Fed is able to be very reactionary to the labor market data, and that's why we think they're still going to be able to cut in September. Inflation's looking a little bit cooler, and we're starting to see signs that the economy's moderating.
Okay, not to go existential on you, but there's this question about how effective some of the rate hikes have been that the Fed effectuated, whether the rate hikes actually themselves have been slowing growth and inflation, or whether it's just simply the sort of year-over-year comps on the post-pandemic realities that we've been seeing. So how do we know that rate cuts are really going to have any effect when it hasn't really been percolating through the system all that much?
So there are parts of the economy that have been feeling it. A lot of it's small businesses. They're the ones that really struggle with higher financing costs. So to the extent that lower rates would help to improve their profit margins, that would certainly have an effect on the cyclical areas of the economy. Equipment spending has been weak. A lot of areas within CapEx that are particularly labor market sensitive are the areas that are sensitive to interest rates, and that's what would feel it. And the rest of the economy, especially on the consumer side, probably wouldn't see much of a difference, but that's kind of the point here.
How are you expecting the team over at the Federal Reserve, Chairman Powell, the FOMC, to engage with some of these themes next week?
It should be an interesting one. I think what we'll see is a continuation of kind of the same, although perhaps their tone will shift a little bit more dovishly. We're going to have CPI on the second day of that meeting, which will certainly set the tone.
Yeah.
We're looking for 0.27% on core CPI, which would be consistent with a core PCE of 0.2%, which is a second month in a row of core PCE kind of close to their target.
So we are sufficiently restrictive right now, right? Not too restrictive? Sufficiently restrictive?
I would say sufficiently restrictive. I think the Fed should be cutting at some point this year in order to sort of reduce the risk of something bad going wrong, like last March,
well, let's
the banking crisis.
Put some numbers on this. What does that dot plot look like come Wednesday? In line with 1 or 2 this year?
I think I'm looking for 2.
You're looking for 2?
Yeah.
September and again in December?
September and December, and I think that's kind of what the Fed will pencil in as well.
Tougher question, 2025. When you start to really think about 25 and some of the policies that could be introduced that could really, really shape this economy over the next 12, 24 months and beyond?
So the two most important ones arguably are going to be tariffs and what happens from a labor market perspective in terms of immigration, right? So we had the executive order today that probably won't have a big, or yesterday, that probably won't have a big impact in terms of labor flows. If Trump is in the office, he'll probably restrict patrollees coming in, this humanitarian parole. That has been a really important support for labor supply, but labor demand will probably be soft enough by then that it might not be that inflationary.
Go ahead. I mean, just to bring it all together, I guess the question is, Adel Hosseini was on and he said, investors are nervous about eroding governance in emerging markets. Are we going to see the same kind of fear expressed in the United States in a serious way in both the economic numbers, but also with market reaction?
It is possible. I mean, the one thing is that Trump is fairly market sensitive, so if you start to see anything unravel from that perspective, I would imagine the dynamics will change. The second important piece of the puzzle for next year is going to be on tariff policy. It probably will get tied into a TCJA extension, so that probably won't happen until the end of 2025. So next year, you might not actually see the inflationary impacts. 2026 could be a different story, and that could be a much more challenging environment.
You said it. The greatest regulator of some of the former president's worst instincts was the S&P 500. Or for that White House, it was the Dow. It would be the Dow. That was the big focus.
Yeah, which is the reason why people say he might retrace if it's sends the market down.
Maybe. Stephanie's good to see you. Thank you. Coming up in the next hour, your lineup absolutely stacked. Former Barclays CEO Bob Diamond, Bloomberg's Mario Parker, PIMCO's Rich Clarida, and Matt Brill of Invesco. From New York, this is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The Fed really needs to think very long and hard about cutting rates when you have this degree of speculation still in the markets.
The Fed is going to be more sensitive to weaker economic data than they are to continued strength.
The Fed is cutting rates anytime soon, especially ahead of the election. Things have to slow down in a more pronounced way than they have done so far.
Equities are still well positioned, especially in the context of rate cuts coming.
Our view has been on the Fed that nothing changes until something changes. Very much sitting in that space very comfortably right now.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, coming off the back of 3 days of gains on the S&P 500. Friday, Monday, Tuesday, into Wednesday, equity futures positive by 0.2%, and we're coming off the back of quite a rally in the bond market, inspired by one thing: weaker than expected economic data so far this week. ISM manufacturing, onto job openings later on this morning, onto ADP, and Lisa, then the ISM services read.
What's been interesting, as you point out, stocks have eked out gains. But which stocks have eked out gains? It's been the S&P and the NASDAQ, not necessarily small caps. Small caps have kind of lost out regardless, because bad news is bad news for them. On a broader level, there is a question about if you get rate cuts, if you get declines in yields, does that support valuations where you are, even if it's for the wrong reason?
Bad news is good news for this Treasury market, right? Quite a drop. Double-digit basis point decline, 2-year through to 10-year over the last 4 days.
30 basis points, almost 28.6 basis points when you look at the 10-year Treasury, not to be overly pedantic about it, but this question of this is the longest stretch and the deepest stretch of declines that we've seen going back to December. Question is, for the longer term, does it matter that much? Does this really reset some of the appetite globally to go buy Treasuries, domestically to buy Treasuries at a time where there still are some of those questions percolating? To me, it just highlights again the lack of certainty that people have about the long-term paradigm as well as Fed policy and the response to data.
The dominant question in economics on Wall Street this morning and over the last 2 days is, what is normalization? Are we normalizing, Or are we going somewhere bad? And we're trying to work that out. And not just us, of course. The FOMC's got to do the same thing next Wednesday when they produce a set of forecasts for the world to see.
Which is a reason why it's sort of questionable, as you mentioned last week. Are they going to do anything? Maybe they just sort of keep it the same, saying, we don't know. We will move as the data comes in. We do get a slew of data, including CPI, ahead of that meeting.
A week today, CPI and a Federal Reserve decision, Chairman Powell news conference, and a whole set of forecasts to get our hands around as well. Let's get our hands around this market at the moment. The scores look like this on the S&P 500, positive by 0.2%. Yields have been lower over the previous 4 days. We're higher this morning by a single basis point, 433.96. Plenty of checks on what's happening in the FX market ahead of the ECB tomorrow, Lisa. 108.69 on the euro dollar.
A lot of people are looking to understand what their guidance is for July, whether they're going to cut rates there. I do think, and I have to say, I got some hate mail about mentioning Bank of Canada with sort of a shrug of my shoulder.
Was the hate mail from Canada?
Yeah, basically saying, you know, you're really going to dismiss us. I was actually serious because this might be the first bank to cut rates, and it's kind of a 50-50 right now in markets. If they cut, what is the guide to the ECB? I care about Canada. It's always sort of interesting. It comes out. I always look at it.
Who are you looking at? What's their name? Who are you talking to? I feel like this is just for one
James.
person. James.
I'm watching Canada.
Okay.
There we go.
James, I'm watching Canada too. Thanks for watching. Appreciate it. Coming up this hour, we won't talk about Canada. Bob Diamond of Atlas Merchant Capital on the Fed's path forward. Bloomberg's Mario Parker as President Biden touches down in France. And PIMCO's Rich Clarida on a generational reset of bond yields. We begin with our top story, cooling labour market data reinforcing speculation the Fed will cut rates this year. Bob Diamond of Atlas Merchant Capital saying the market has caught up to reality of Fed rate cuts, saying, quote, any cuts they make in the second half will be minor. Bob joins us now for more. Bob, good morning.
Good morning, Jonathan.
The market's moved towards you. They were looking for 6 cuts this year. It was ridiculous. We're now looking for like 1 or 2. Can we just start with what you think of the recent economic data, the information we've sort of got our hands around over the last couple of days?
I think it's consistent with what we're seeing in the whole first half, which is if you look at the second half last year, then the numbers coming out were a little bit pleasing for economic growth, probably a little bit pleasing for inflation being lower than we expected, and the labor market continued to be very robust. You get into the first half of this year, and the economic numbers are probably a little bit weaker than we thought. The inflation numbers are a little bit higher than we had anticipated. And for the first time, we're seeing just a little bit of looseness in the labor market. I don't want to overstate that because I think, you know, the labor market is still in very good shape. But I think in both cases, you know, the economy strong second half last year, you can't cut. Inflation a little bit higher than you want this half, you really can't cut. So, Jonathan, I think 25 basis points here or there, who knows, right? There's no precision in this. But by and large, I think the risk for the Fed, the risk for the chairman, is to cut too early before there's any economic weakness and then having to reverse course as inflation, you know, begins to grow. So my sense is they're going to be patient. They're going to be, you know, everyone's used this word data dependent. But until we see a weakness in the economy, or inflation really down to 2%, then they're just not going to cut.
Both the economy and the market have surprised a lot of people. I talked about expectations in January, where we were then, where we are now. Let's talk about where we were last spring.
Yeah.
Last spring, if we were sat around this table, the majority of people were speaking to Lisa, to me, to Anne-Marie, and they were telling us that what we're going to see is a real tightening of financial conditions. Banks won't be able to lend as much anymore. Companies are going to suffer.
Yeah.
Here we are 12 months later, credit spreads are super, super tight. And credit availability, particularly for large companies, is there and ready for everyone, even with rates of 5.5%. You've got your finger on the pulse of this. Have you been surprised by that, the availability of credit to this economy still with interest rates where they are?
By and large, no. And I think sometimes there's an advantage to travel. A lot of times there's not. But I spend a fair amount of time in the Middle East and in Asia. And when you listen to people there looking at what's going on in the U.S., it was, okay, waited too long on you know, taming inflation, raised rates 550 basis points in 9 months. We all know the economy is going to collapse, and it's kind of like, really? Like, the economy is still there, the labor market's still there, and it's so clear to me that we have such a competitive advantage in this country with the depth and breadth of the financial services industry, and I think it's a real asset. Europe doesn't have it, China doesn't have it. You know, hedge funds, venture capital, private credit, all of these ways to get credit into the economy, into small businesses, into middle market businesses. We have many investments with Cascadia in Seattle and Austin, with Marshberry in Cleveland, investing in advisory platforms for middle market and family-owned businesses. And it is incredible how many angles we have to get credit out into the economy in this country relative to other countries. And I think it has, I think looking at the U.S. from outside, there's real admiration for how did we manage this with 550 basis points in 9 months and the economy has stayed relatively stable.
There also is a question underpinning that, which is how effective is Fed policy and really having any influence whatsoever on credit growth, et cetera. There's a theory that the economy has just been a whole lot more resilient to rates as they go up to 5.5%. Is anyone talking about how rate cuts won't necessarily have any effect whatsoever on the economy also, especially just peripheral ones, because of all of this credit creation already in the system?
I think there's a lot of people that have an axe to grind. If you're in commercial real estate, you want to see rates come down for kind of the sector that you're in. But you mentioned history, Jonathan. Yeah. If we take a more historical look, since 2008, the great financial crisis, 2008 until the Fed started raising rates, Fed funds averaged just under 1%. If you look at 2, 3, 4 decades prior to 2008, Fed funds would have averaged about 4%. So I think we're in a much more normal environment right now. And I think the worst thing that could happen is that we saw the Fed, if the Fed starts aggressively cutting rates, it's going to be because the economy is weak. And so that's not necessarily good news. So we're not rooting for Fed rate cuts, but we do think, if you look out over the next couple of years, rates in the 4 to 4.5%, 4.5 to 5% range is probably the logical explanation. A bit lower than here over time, but not below 4%.
We've been talking about is good news, bad news, bad news, bad news, bad news, good news. For smaller companies, it has been bad news regardless, it seems like, over the past couple of weeks. And for small banks, regional banks as well, in particular, the KBW index is down some 12% on the year, really down sharply over the past couple of sessions. Do you think that rate cuts will eventually be positive for these shares, or do you think that there's some sort of structural issues with holdings and other potential challenges that just make it bad news is bad news for them no matter what?
We have a strategy to invest in regional banks, so I do have a bias here. We see a great opportunity, and kind of if you turn that on its head and say you're a strong regional bank, you've addressed your capital issues, and we all know that higher interest rates were impacting their treasury portfolios as they have for every bank, and they've impacted loan provisions. But let's just pick an example of an investor like us investing in a strong regional bank, so the capital levels are fine, there's no issues with the portfolio, and then look forward. You're really doing well with interest rates at this level. Higher interest rates are really good for banks, and it's been a long time since we've seen loan demand like this. So the go-forward position for a strong regional bank is actually outstanding. The question is, will we see consolidation, which we believe we will, and are there strong banks, which we believe there are? Okay. And I think one of the great attributes for again, you go back to the depth and breadth of the financial services industry in the U.S., the fact that we have these regional and community banks providing a service that the larger banks can't to small family businesses is a real strength.
You talk about consolidation. I wonder how much is going to be consolidation and how much is going to be failures. Yesterday, there was Access Financial, the latest potential target of some bad research, and a lot of it stemmed around its commercial real estate holdings. Some people argue that lower rates will actually cause property prices to go down because it will allow more sales to kind of get unleashed in the market. Do you think that there's going to be a rash of failures, that basically it's sort of like people sniffing out cockroaches, and if they smell something that's not okay, they just pull their money, and it's sort of a self-fulfilling prophecy? Do you expect that kind of activity to sort of come back?
Well, I think in our view, one thing that is certain is that since 2008, when the regulators and the political leaders claimed that we will never see too big to fail again, the larger banks in the U.S. have gotten bigger, more concentrated, closer to government, and far more systemic. So they're safe, the economy is good, but it's in no one's interest to allow the larger banks to continue to acquire the smaller banks. What we think is appropriate is that we strengthen some of the strong regional banks, whether it's the capital markets, whether it's Atlas Merchant Capital doing investments, to give them the capital levels that are necessary for them to acquire some of the banks that I think are too small to succeed. Really, really good banks that have been more like community banks that have had good, solid ROEs for decades. But in this environment with the shock in rates, they have to adjust their treasury portfolio. With the loan loss provisions, they have to adjust that. And the thing that is more permanent is the regulatory intrusion post-SVB will increase their costs around technology and KYC. So we do see an environment where consolidation is a positive and a natural, as opposed to weekend failures and big banks taking them over at the last second.
We started this conversation by talking about some of the misconceptions people had from the outside looking in, from outside of America looking inside America. From inside the financial system, what do you think is the biggest misconception that people in Washington have about the world you work in?
I think they misunderstand what has happened over the last 14, 15 years since the financial crisis with larger, more concentrated, more systemic, the big four, the big eight, if you look at the top banks. I think, between the top 2 or 3 banks of Wells Fargo and Bank of America and JP Morgan, it's over 50% of the deposits. And we saw a recent report where if you take 4,500 banks in the U.S., JP Morgan alone is 20% of the profitability. So banks are more concentrated. And I think what they're missing is the value to the economy of having a strong, robust regional and community banking sector. And I think for us, that is an opportunity over the next couple of years. And I think the thing that is really, really key here that people miss is the go forward. If you are a healthy bank, the go forward with higher interest rates and loan demand is outstanding. The question is, are you ready to be investing and are you ready to be lending?
Precisely. What's the starting point? Bob, you're going to stick with us. Bob Diamond, sticking with us for the next 15 minutes or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden landed in Paris this morning. He's in France to mark the 80th anniversary of the D-Day invasion. On Thursday, he'll visit hallowed ground near the beaches of Normandy, where rows of headstones mark the graves of U.S. soldiers who died to bring an end to World War II. He's speaking on Friday at Pointe du Hoc, a spot on the French coast where Army Rangers heroically scaled 100-foot seaside cliffs to overcome Nazi defenses. Shares of Dollar Tree rising in the pre-market, the retailer announcing earnings that beat estimates and saying it's exploring a sale or spin-off of Family Dollar. Less than a decade ago, Dollar Tree beat out its rival Dollar General to acquire Family Dollar in a roughly $9 billion deal. And eBay is dropping American Express cards as a payment option. The online marketplace says it's no longer accepting Amex because of what it says are unacceptably high fees, according to an email reviewed by Bloomberg. eBay plans to notify customers this week about the change, which is set to take effect August 17th. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process.
The latest from Washington, D.C. up next, live from New York City this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York, welcome to the program. Equity futures positive by 0.2% on the S&P 500. Under surveillance this morning, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process. This action will help us gain control of our border, restore order into the process. This ban will remain in place until the number of people trying to enter illegally is reduced to a level that our system can effectively manage.
It's the latest. One day after signing an executive order aimed at curbing migrant flows at the southern border, President Biden touching down in France to mark the 80th anniversary of D-Day, with plans to meet Emmanuel Macron and Ukraine's Volodymyr Zelensky later this week. Bloomberg's Mario Parker joins us from Washington for more. Mario, can you go through the list of items for the next 2 weeks that this president has to confront?
Yes, the list of items is a great way to put it, right? We've got the president in France this week. He comes back to Washington, D.C., immediately pivots back to Europe for the G7 as well on the week of June 13th or so. And so what you're seeing from the president, at least over the last couple of weeks, cumulatively, is he's going down, he's ticking a box on all of the things that he has to shore up ahead of the election, right? While these are geopolitical issues, with 5 months before the November election, there's nothing that doesn't have at least a hint of an effort toward the furtherance of him being reelected to the White House.
When you think about what's on the agenda for the next week or so, Mario, and then you compare it to the concerns of the electorate, there's not much crossover here. In America, the concern is the domestic economy and immigration. Abroad, that we're talking about Ukraine. Is that helpful or unhelpful for the sitting president next week?
Well, here's what's interesting about that, right? In the polls, Americans care much more, to your point, Jonathan, about what's going on at home, right? Domestic issues, the economy, inflation, the cost of housing, et cetera. Biden scores quite poorly relative to former President Donald Trump in the latest polls in those subjects. Where he does have a strength, though, is in terms of character issues, in terms of preserving democracy. And so what you see him doing, essentially, is playing to his strengths, right? He's essentially saying he's going overseas to rally support for Ukraine against Russia's aggression. He's last week quite publicly and full-throated, may I add, saying that he wants a peace deal between, a ceasefire between Israel and Hamas, right? The backdrop before that was his entreaties toward black voters. And so you see him trying to kind of tick off both his liabilities, but also play to some of his strengths with the hope that voters essentially will give him some credit there.
Just before the big debate later on this month, Mario, appreciate the coverage this morning from you and the team. Thank you. Mario Parker down in